order. Good morning. Can we have a roll call, please?
Yes. Governor Michelle Lujan Grisham. Land Commissioner Stephanie Garcia Richard. Treasurer Laura Montoya, told she will be late. DFA Secretary Wayne Props. Nick Tejas. Catherine Allen.
Here.
John Bingaman.
Here.
Kelly O'Donnell.
Here.
Alan Sanchez.
Present.
Kurt Summer. Here. Mary Roman.
Here.
That's 6 in the affirmative. We have a quorum.
Okay, thank you very much. Let's move on to the approval of the agenda. Is there a motion to approve the agenda?
I move to approve the agenda as presented.
A motion, member Sutton, is there a second?
Second.
Second, member Allen, can we have a roll call vote, please?
Treasurer Laura Montoya.
I'm waiting.
Oh, man. DFA Secretary Wayne Props. Nick Tejas. Catherine Allen.
Here. Yes.
John Bingham.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer. Yes. Mary Roman.
Yes.
7 in the affirmative. Motion passes.
Okay, next item on the agenda is the approval of the minutes from February 24th. Is there a motion to approve the minutes?
I move to approve the minutes as presented.
Okay, motion by member Summer. Is there a second?
Second.
Second by our state treasurer. Could we have a roll call vote on the minutes, please?
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Props. Nick Tejas. Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer. Yes. Mary Roman.
Yes.
7 in the affirmative. Motion passes.
Okay, next item on the agenda is our SIO remarks and an update on the CIO search process from SIO Clark.
Great, thank you very much, Mr. Chair. Good morning, Chair and members. I know it has been a lengthy search process for a new CIO, and my team and I, in coordination with Dr. Ashley Monk and Madison Gesser, have spent an enormous amount of time finding the right person. It is my great pleasure to announce that the search is concluded, and I have selected Kristen Varela as our new CIO. She will be joining us momentarily to make a few remarks, but first I'd like to speak briefly about Kristen and why I chose her. I anticipated we would have good interest in the position, but I was absolutely blown away by the caliber of people I was able to talk to across the country and beyond as part of this process about this job. This was a very competitive process, and we had many amazing potential options. It became apparent quickly, though, that what we needed was not just an amazing CIO, but also someone who would be an amazing fit for SIC, someone who represents our values, and someone who has the skill set that is needed to take us from where we are today to a world-class asset allocator. I need someone who has experience leading, but who has also been in the trenches and has worked to build up and professionalize processes and procedures. Kristen Varela is that person. She is a homegrown New Mexican who had to leave to pursue her career and now has a chance to return home. She's currently the CIO at the Employees Retirement System of Hawaii for the last several years. Previously, she was with New Mexico Para for 8.5 years, including as deputy CIO for 4.5 years, and then interim CIO. Before that, she was an investment analyst and trust securities specialist at First National Bank of Santa Fe for a total of 6.5 years. The State Investment Council is working to become the most influential sovereign wealth fund in the United States, but realizing that vision will require more than asset growth. It will require institutional clarity, governance discipline, structured innovation, and the ability to attract and retain exceptional talent. Her experience building disciplined institutional platforms across 2 pension systems, rebuilding trustee trust during transition, formalizing delegation structures, strengthening internal underwriting, enhancing risk frameworks, and investing in talent infrastructure aligns directly with the structural evolution we envision for SIC. She has formalized internal investment, operational, and legal due diligence frameworks, and embedded macro scenario analysis and stress testing into decision-making. She established internal challenge sessions prior to capital deployment. She reduced siloed asset class thinking. And she encouraged cross-risk fluency and total portfolio awareness. Kristen was strong at every level of this process, and we really believe she will be incredibly committed to the mission and improving the benefits that we deliver for New Mexicans. And finally, she is a wonderful person and someone that my team and I are excited to work with over the next decade or more. This is a boomerang story that we love to see. And now I'd like to turn it over to Dr. Ashby Monk, attending virtually, and Madison Gesser here in person to talk about the CIO search process, and then turn it over to Kristen to answer.
Thank you, John. Yeah, thank you all for having us. We're incredibly excited to be here, and also just very grateful to be able to work with the SIC, which is such an important institution, not only in New Mexico, but really for the country, in terms of the impact and all that you're doing on the investment side. As a way of introduction, my name is Madison Gesser. I'm the founder of Fram Partners, and we're an executive search firm focused exclusively on institutional asset owners. And I co-led this search in partnership with Ashby Monk, who is the executive director of Stanford's initiative on long-term investing and a long-tenured researcher in the space. I'll pass it over to Ashby in a moment, but again, we're really grateful to be here and also grateful to be able to have worked with the SIC over the last 18 months. A lot of that deep work and familiarity with the organization was what allowed us to work closely and as an extension of the team with full context, which really allowed us to go out and search on behalf of the organization to find the right fit, the right leader, the right culture fit. So just very excited for you all and excited for this next chapter. I'll pass it to Ashby to get us kicked off on the actual search process. And on the slides, if we want to just pull those up, that would be great as well.
Great. Good morning, everybody. It's great to be here. As the slides come up, I'll introduce myself a little bit more. So I'm Ashby Monk. I'm on faculty at Stanford, and this is a real pleasure to be here in front of you because I feel like we get to come back and describe what is, in my mind, a very successful process. So we get to stand in front of you and say we found the right person for the right job, and that's exciting. Few more slides ahead, please. Next one. All right, great. Nope, back one. Sorry, back one more. All right, well, hopefully you can figure out how to go back. So we kicked off this project with SIC. I mean, it feels to me like it's been about a year and a half. So it tells you the sense that this wasn't just about a search for me. This was actually about helping the SIC develop a unique identity, which means going deep with the team, with the council to understand the advantages of the organization, the weaknesses, the challenges, and the plans, and recognizing the large sums of money that will be coming into the organization and the ambitions to be a world-class sovereign wealth fund. And I mean world-class. So this fund will be the biggest sovereign fund in America in the future, surpassing Alaska. It won't take very long to get there. And so this will become America's sovereign wealth fund. And so we really set out to design a plan for the organization reflected in the document you see in front of you that was presented in October, to really become a role model for the world. So the way organizations learn from each other is through documents like this, where we present best practices and then other organizations seek to copy that. We think New Mexico can be, the equivalent of a Yale model or a Canadian model, but a New Mexico model based on the unique identity. Next slide. As we got through the process of writing that 20-page document, there was an opportunity to hire a new CIO. Prior CIO left. New CIO was coming in at the same time as we were crystallizing some of the big projects that needed to be pursued. On the top left here, you see the three main projects. The three main challenges, and then underneath that, you see the key projects that we detailed in the document. And so before we even set out to find a chief investment officer, that could take on this organization for the coming decade, we already had a strong grounding in what you need. And that was very helpful. It gave us a lot of guiding principles to go out and do our search. Next slide, please. We set out to find core candidates that had strong alignment with New Mexico. On the first category there, you'll see mission alignment as well. So that's really understanding what the organization is about. We've written, now putting my academic hat on, I've written papers over the years on how you attract the best talent to pension funds and sovereign wealth funds. And one of the things we described in our research is something called the green, the gray, and the grounded. So forgive me for trying to create little frameworks, but the best talent that works at Sovereign Fund tends to come in three forms. It's young people who really love the job opportunity. It's people that are later in their career that want to come back and mentor teams. Or last, the grounded, it's people that have a strong connection to a place, to a culture, to a region that simply want to come home. We've seen that with people going back to work for the New Zealand Superannuation Fund, the Alberta Investment Management Corporation, and we thought we would find that here as well, where we might be able to find somebody that was truly bought into the mission of New Mexico SIC, and we could bring them home to run this organization. And so we purposefully sought that out as part of our search process, looking within the state, but also keeping in the back of our mind that people might have left the state and we might bring them back. Obviously, there's a few other areas that we prioritized, which really reflect the projects that we think the organization needs. So building delegation frameworks, building process, establishing formalized, call it artifacts for investment decision-making, really building a new culture and setting a tone of leadership for the organization. Understanding that we are about to enter the era of AI and what that means in terms of data, information, analysis, and really baking that into an organization that has operational excellence so that the SIC can have faith to delegate some authorities to this organization. You don't want to delegate authorities before the operational excellence is in place. And so these things all need to work together. And so these were in our minds as we set out to go and run a search, which the next slide begins to kick off. Next slide, please. Right, so first, we understood the role. We worked closely with John. Then we went and we did a large mapping, mostly of my network. So, as a academic that studies sovereign funds and pension funds, I'm fairly unique. I'm not the most popular person at cocktail parties, but I have a large network of asset owner investors, thousands, in fact, that I track. And I don't track them because I'm trying to be creepy. I track them because I'm learning from how they operate and where they're going and how they're thinking. And so I am lucky to have a database of talented investment officers from around the world in different roles that began the foundation of this project. And so there was call it a Venn diagram that began to take shape between the role and the candidate profile and the market map and the pre-screening, pre-qualification that we did. And then Mattis and I began to send out emails and do the initial interviews. And Madison really, if I'm honest, did a huge amount of the work to actually get that done. So I have to acknowledge that I'm not sure we would be here today if Madison didn't help me manage this whole process. Next slide, please. Actually, Madison, this might be your slide. Did I skip you? Madison? Nope, can't hear me.
Maybe muted.
Yeah, Ashby, feel free to keep going. You were we were maybe on mute for a moment.
Sorry, I just kept rolling through the slides. I forgot that I was going to let you run with slide 5. All right, next slide, please. So I sit in a seat where I study asset owners, so pension funds, sovereign funds, endowments, et cetera. And so I know what good looks like. And we believe the state of New Mexico is on this list. And so that's what I want you to understand is the caliber of talent we went after. We went after people that could be the chief investment officer of any of these organizations, right? This is not, we did not set out to have a limited scope process. We set out to find a person capable of running America's sovereign fund, truly being ambitious about the organization's future. I've sort of talked about this. So next slide, please. Together with Madison, we initially drafted up a candidate pool of 500 plus people. This was then reviewed almost each individual person against our criteria for what we were looking for. I personally sent out over 100 literal personal emails to potential candidates asking if they would have any interest in this. We then moved into some pre-screening of the people that said, I'd be open to a conversation or I'd be opening to learning more. Generally, we shared some of the material from our project with John's permission. In certain cases, we shared the memo so that the people could be fully aware of the size of the project, the ambitions of the organization. Again, that really helped to be able to send our identity memo around to potential candidates. Just really brought them up to speed on the excitement of the organization, which is baked into that documentation, but also the challenges. We then used that memo to really run the interviews, say, what did you think of the memo? How did you, respond to it? And to get a feel for their approaches to running organizations. We then started turning over pre-screened, pre-qualified candidates to the SIC team. The SIC team, if I'm right, was a group of 5 or 6 internal people, depending on the candidate and the time, and they conducted over 200 hours of interviews. We were then, after multiple interviews with individuals, invited 2 candidates to New Mexico. Some of you probably met the candidates at that time. And 1 candidate was given a final offer. And that's who is going to be speaking to you next, which is exciting. Next slide. We see this organization as inventing a new type of model. So the sort of development fund locally, intergenerational savings fund, stabilization fund, education fund. But we saw role models coming from different organizations around the world that we prioritized. And so on the left, you see the types of organizations that we drew our talent from in order to really find the right person with the right skill set. Next slide. Again, I've sort of riffed on this in the very beginning, but these are the sources of candidates that seem to be the most fruitful, looking at domestic sovereign wealth funds, stabilization funds, permanent funds, endowments on the right, people with New Mexico ties. This is our green, gray, and grounded thesis, the grounded being the types of people that would be interested in coming back to New Mexico. And then the leading pensions and global sovereign wealth funds. And I think even the team, I don't want to put words in John's mouth, but I think they were perhaps surprised at how much interest was expressed from global CIOs. So we definitely had an incredible cohort of people around the world engaging with us, albeit on a confidential basis. So it's not like I'm going to sit here and say their names, but truly incredible people that were interested in this job. Next slide. And part of that was not because I had a good network. It was because people picked up the search. Friends of mine at different places posted the search. So our friend Ted Seides at Capital Allocators sent multiple emails. I think it was in the range of 7 or 8 out to his 100,000 subscribers. Ted runs the #1 podcast for asset allocators in the world. Each episode receives hundreds of thousands of downloads. He published the CIO search, I think it was 7 weeks in a row as on his weekly update. Pensions and Investments, Markets Group, and others all came together to also talk about the search. And because of my name, and you see my big face up there, people reached out to me when they wanted to learn more. And so those candidates made it into the funnel as well, outside of my own personal network. Madison, over to you. I'll get it right this time.
Yeah. Yeah, so with all of that work, obviously, it's been touched on, but this created a really robust pipeline of candidates, which we felt really good about. And frankly, we're even surprised at times the amount of international interest, the amount of interest from different categories of asset owners. I think people really saw the appeal of coming to New Mexico and helping build this amazing fund. 500 total potential candidates, 100 plus engaged, and then 50 plus candidates we really pre-screened and kind of matched back to those early attributes we walked through and matched back to all the projects that we outlined in the plan, which gave us a lot of context to do that. But what we were really also proud and excited about was the diversity and inclusion in the search. So we had 36% female participation of those engaged candidates, which according to the CFA Institute is significantly over their benchmark of female participation at the CIO level, which we felt great about. 15% included diverse and minority candidates, and nearly 20% either from local New Mexico organizations or with some tie or heritage to New Mexico, which we also felt was really important to include in the search. And many of those candidates actually turned out to be really impressive in their own merit. The role types represented, you can actually see on the right, really informed us as we went through the search process of the different attributes we could gain from different types of candidates. We spoke to not only CIOs and past CIOs, but heads of asset classes, heads of risk and analytics, senior managing directors who have built phenomenal co-invest programs and direct invest programs. So that really was informative and really exciting as well. And if you want to go to the next slide. This is just an anonymous sampling of a few of the candidates we spoke to and the types of caliber of candidates. So we've touched on this, but the CIO of a really large international pension, who's had experience managing some of the world's largest in different continents, both with public and private markets experience and also CEO experience. The CIO of a large US pension plan who had a really strong background in governance and leadership, communication, strategic projects. Deputy CIO of a pension plan and the head of a private markets team, which is really phenomenal and world-class, which has set up co-invest and direct investment programs. Even in the endowment sector, a deputy CIO of one of the highest performing endowments with some really innovative experience, kind of on the cutting edge of emerging manager programs. So we felt really good about these different archetypes and felt like the pipeline created a really competitive process. If you want to go to the next slide. And the final slide here. So our evaluation framework, just of how we really assess these candidates, we kind of broke it into 3 core sections. So first, aligning with those core attributes we mentioned before, which were driven by the strategic report we produced, obviously demonstrated performance. So a track record on paper of producing returns, beating benchmarks, performing and demonstrating very tangible examples of how they implemented projects was really important, and I think helped certain candidates stand out. And then culture and organizational fit, someone who could come in and really not only be an investor, but be a leader and a cultural kind of renewal for the SIC going forward, someone who could interact with the legislature, the council, and the staff and be a true leader. So yeah, That's the end of the presentation. Ashby, if you have any last words on just the SIC going forward, feel free to close us out.
Yeah, sure. It's just been a real honor to do this work. You know, my day job is I'm an academic. I didn't set out to be a consultant or an executive search person, but it's really been fun to put together this initial plan and then to help you find the person to implement it. And we're not going away. I'll be around. You know, we're only a quick flight away, but really excited to see the next phase, and I can't wait to hear from Kristen.
Thank you very much. I think we should hear from Mr. Dowd.
Chair and members of the council, good morning, and it is such an honor to be in front of you today. I had a few prepared remarks, and honestly, John and Ashby and Madison have taken all the words right out of my mouth. So let me just start with saying I could not be more thrilled to be in front of you, and I am so honored to have been considered in this very rigorous search, which, by the way, was one I've been through searches, as you all can imagine, and this was one of the most impressive and thorough searches that I've experienced. And along the way, I also got to know the team very, very well, which made me even more excited about this opportunity. So quickly, just a little bit about me. At the risk of being slightly repetitive, I am a local New Mexican through and through. So I come from a family of multi-generational Northern New Mexican ranchers in Pecos, proud alumni, actually, and have really shaped my entire value system as well as my investment process around the values that the community has given me there. So New Mexico is near and dear to me, and the opportunity to come home and serve the place I love the most was very, very powerful. It was one of the very first things that made me take the email, take the phone call, and start having these conversations. That said, I am pretty proud of what I've been able to do with the high functioning teams that I've worked with in the past. So I'm rounding out almost 2 decades of experience in the asset management, portfolio management, and institutional investment space. And as John said, I'm currently serving for a fantastic plan, the Hawaii Employees Retirement Plan, where in that time, my team and I have taken the portfolio from 22 billion to 26 billion, and we consistently meet our benchmarks, first being steady, stable return generation for our members. And before that, I spent 8.5 years in New Mexico, actually working for my own family who was in the plan. So at New Mexico Para, I served in in an interim role before I left, but also various leadership roles, helping build out communication, transparency, and process in that organization. And I will tell you, my own dad just retired from that. So that work is super valuable. And I was so honored to do that. In terms of my investment approach and what you can expect from me as I come on, I look to build disciplined and risk-aware portfolios, and I focus on long-term outcomes over short-term results. So steady compounded results really matter, and our team should be able to look toward the long-term outcomes. I seek to be honest and transparent about risk and set expectations for a portfolio, especially in these volatile markets. And I always want to be honest, and I want our teams to be honest about the value that complexity adds. I believe in complexity, but want to be sure that that it is always scrutinized and measured accordingly. In terms of governance and process, clear frameworks and strong alignment with the council is what I'm really looking to do, and I'm looking to for the team and I to be consistent in our transparent communications and really be able to implement the values that the council has outlined for us. So what you can imagine from me in the first likely year is understanding the objectives, the risk tolerance, and the overall definition of success for the council, and being able to reflect those values and those core principles into our implementation process. I would also just like to note that it's an amazing opportunity to build out to add to a very strong team and to work very closely in building out a plan that is very clearly structured for success. So I once again want to thank everyone for the time and the opportunity. I'm so excited, and I will soon be sitting in front of you, working with each of you. I want to thank John and the SIC team for the hours of time that they've spent with me. It's been the greatest honor. And Ashby and Madison, thank you so much for all of the hard work that you've done. I will stop, and I'm happy to answer any questions you all may have.
Thank you so much. Any questions or comments from the council on the CIO search process?
Well, congratulations on your selection. We're happy to work with you.
A great process and
Yes.
we're look forward to welcoming Chris. I have so much more to say. You guys are acting like this isn't a big deal. This is national news, you guys. This could be international news. All right. So first I want to thank John. I want to thank Dr. Ashby Monk. I want to thank you because we've gone through a lot together. Can I mention that we had a visit?
Yes, yes.
Okay, so about a month ago, we had a visit with the top two contenders. I won't say who the witness. But what I really appreciated is that Ms. Varela knew our team. She knew every single person's name. She knew what they did. She valued them as an individual, and I have them in a very high regard. Really respect our team. And so to see someone else wanting to come into a team that understands that teamwork makes the dream work is a really big deal to me. When I first met Ms. Varela, I did not know who she was. She was speaking on a panel for a pension fund conversation, and I was working on emails at the same time as listening to them, and it was one of those female panels that they put up. I sort of don't like those, but it's cool. So she's talking and she just keeps bringing it back to being a fiduciary and what she's doing with her pension fund. And then she does a little bit of like accent things that made me think, gosh, she sounds like really awesome about what she's doing. And then I was like, she sort of sounds like a New Mexican. So I start Googling her to find out who she is and what she's done. And then come to find out she was actually from New Mexico. And then I became like a super fan at that moment. That was 2 years ago. Then when I found out she was one of the two top ones, and I knew that it was taking forever, and I know I was giving you guys a hard time about it because we really need someone in here to help out with the team. But it was a very thorough and thoughtful process, and I think for anyone who might have had a little bit of doubt on what type of process it was, or because she's a New Mexican, that's why we picked her. Everything they just said just now said that, again, she had worked 10 times harder to get the position. So for someone who leaves Hawaii, which Hawaii is beautiful, but not more beautiful than New Mexico, Hawaii to come back to New Mexico and work in a fund that is going to the next level at the national level, I might even say international level, but I'm being maybe a little tiny bit biased, is so impressive. And I did want to make sure I double check this, Kristen, if you wouldn't mind. You're the 2024 and 2026 Elite 100 CIOs, the 3-time candidate CIO for Industry Innovation Awards finalist, the top 40 under 40 next generational leader with 15 years of experience, and you just became the 2026 Elite Institutional CIO with the Markets Group. Is that correct?
That is correct. Yes, I actually now have 18 years of experience, so I am gathering more time together.
Sorry, I was reading through you last night at 2 a.m. I also looked at their investment policy, which is 128 pages. But just so the council knows, they have a proxy voting policy. They have an ESG policy. They have a governance policy, corporate governance consisting with council beliefs and whatever else. It was really intriguing. And so I know you had a smaller fund, but the idea of what you've done in Hawaii, and I know Hawaii is uniquely different in that they're similar to New Mexico in how much they love their state and how they believe in their state. And so I think even your contribution to Hawaii coming back to New Mexico is huge. And I'll just say the elephant in the room, as a Latina who never sees people like me in the room hardly ever, except in New Mexico, this is a big deal for me to see a representation and reflection of somebody from my own home state representing our people, our sovereign wealth fund, and has the caliber of skill set to have gone anywhere she wanted to, and instead is going to bring that skill set back to New Mexico. So I am very grateful for your guys' process. you did mention some percentages of what you did on the data. I got the 36% on female participation, congratulations on that. 15% minority candidates, and then you said ties to New Mexico, but I didn't catch the percentage.
It was a 19%, so close to 20% of
Wow.
the candidates we really engaged at the top 100.
So that tells me that those are some really cool numbers, and that it obviously was a thoughtful process to have caught everybody in the bucket. So congratulations on that. Congratulations to you. I do have to also say this, and I know this isn't about John, I'm just gonna steal your thunder for one little moment. But when we hired John, well, I'll speak for myself. One of the things that I thought was an impressive skill set that John has is that he lowers the vacancy rate, he does the hiring really well, and somehow his teams always end up diversified, which helps them to be stronger teams, and did that at economic development. And I don't think any of that is anything less than factual. And so you're putting our money where your mouth is in the sense of developing and strengthening our teams, and then also adding in another added value that I think is gonna really help New Mexico get to the next level. So I'm excited, and everyone in here should be jumping for joy and doing a happy dance, because this is a big deal. And it should take all the news and the front page of the paper, because to everyone in this room today, we just made history. History that when we're all gone, we have done something super awesome and successful and amazing, and opened up some doors and broke up facilities. So that's all I have. Thank you, congratulations, and welcome home, Miss Kristen.
Thank you so much, Treasurer Montoya, and the entire council. I take this responsibility very seriously, and I'm so excited to come home. I really appreciate it.
We're very excited to have you. Thank you so much, and can't wait to see you here in person. And I think at the appropriate time, we should also, acknowledge Vince Smith and his contribution. So I know that we'll do that as well. And let's move on to our short staff briefing.
That's work.
Good morning.
Morning.
That's a tough act to follow. We're gonna switch gears and talk about war and macro things. Yay. But yeah, and we get to be some of the first to say welcome to Kristen. We're excited to work with her and can't wait for her to get here. So since the last time we talked, obviously big geopolitical development, a war with Iran, where everyone is very well aware of that. So I'm going to talk a bit about what the impact of that has been on public equity markets, public debt markets, what the history of market reactions to geopolitical events like that has been. We'll touch on a few macro indicators, and then take questions at the end. So the impact on public equity markets has been fairly subdued. The S&P 500 is down about 6% from the start of the war. International markets are down a bit more, close to 10% in US dollar terms. So part of that is the US dollar strengthening as well. Oil price, it was $65 prior to the war. It was $58 at the beginning of the year. Today it's been, for the WTI, it's been in that $90 to $100 range for quite a while. So a lot of pressures, not a big market reaction just yet, but obviously a huge move in oil prices. And that's something that Don is going to talk about later in today's meeting, the impact on our pacing models and the expectations for inflows and things of that nature. So what's the history of market reactions to geopolitical shocks like this? So looking at the Persian Gulf War in 91, 9/11, the Iraq War in 2003, the Ukraine War in 2022. So market outcomes have ranged from a 20% correction to a 20% rally. So really it's been much more driven by the economic and market backdrop at the time, as opposed to the actual war or event that's happening. So the worst market reaction was the Ukraine war in 2022, but that market correction was really more about the COVID bubble deflating. The elevated inflation pressures, which were exacerbated by what was happening in the Ukraine and continues to happen in the Ukraine, and an environment of rising interest rates to fight that inflation pressure. The most positive market reaction was during the Iraq War in 2003. That's actually, of these conflicts was the biggest and the longest. But the beginning of that war coincided with the early stages of market and economic recovery from the dot-com bubble. So basically the takeaway is there's not too many conclusions to draw from the way the market has reacted, because it's for these regional conflicts, it's been much more driven by what's happening in the macro, what's happening with the markets. So the current economic backdrop seems to be somewhat mixed at this point. Last month I talked about green shoots in January with the jobs report that was really positive. Then February we got a really negative jobs report. So you can never draw too much conclusion from 1 month at a time, but we continue to see this kind of swing back and forth, and we're not getting like a clear, consistent direction of job creation or job destruction. We're kind of swinging back and forth a little bit. There was also a large negative revision to the GDP growth estimates for the fourth quarter. That was partly due to the government shutdown, but the initial read on GDP was 1.4% growth in the fourth quarter, and that was revised down to 0.7%. So the economy not as strong as it initially looked. Higher gas prices obviously represent real immediate pain for the consumer. We all know how much gas prices are up. It's a lot. So in regards to that, and the one big beautiful bill, which is going to deliver higher tax refunds to most households to the tune of, on average, $800 to $1,000 this year. At $83 oil, that's considered the break even for offsetting that tax refund in terms of the additional gas costs. So we're above that now. So if we stay there, that potential tailwind for the consumer from those higher tax refunds is basically being eliminated. So that stimulative impact is not what we thought it might have been. Last month, we also talked about credit card, auto loan, student loan delinquency is rising. Higher gas prices obviously doesn't make it easier for people to pay their bills. Other potential pain points as this carries on. Fertilizer, 20 to 30% of the global supply used in commercial farming comes out of the Gulf region, 10% of the global supply of aluminum, and then the obvious one, cost for shipping, whether it's truck, plane, boat, rail, that's all going to be impacted by higher fuel prices. On the positive side, during fourth quarter earnings season, more than 2/3 of industries reported activity accelerating during the quarter. That was the most positive signal we've seen in that regard in some time. That's been building. So economic activity is building. We're still experiencing broad CapEx strength, and we're seeing signs of emerging productivity gains. So global business fundamentals have mostly been strong and have been supportive of the higher equity prices that we've seen. Most recent developments in the war. So over the weekend and just yesterday, the US strikes on Iranian energy infrastructure, which was threatened over the weekend, were postponed for 5 days to allow for talks to reach a deal to end the war. So that was an interesting test case of like, if this ends tomorrow, what are the markets going to do? We saw, markets were up, equity markets were up 2 to 3%. Oil prices crashed 15%. During the day, those things kind of tempered. Oil price went back up, and the gain in the markets came down and continued today as Iran said, no, there haven't been talks. But an early indicator of when this does end, it will be appear to be positive for stocks, which you would expect. that would reduce that uncertainty, and take away some of the friction in the global economy as businesses adapt to this new environment. So at the moment, public equity markets seem to be pricing in a short conflict. Oil and gas operators in the US seem to be doing the same as rig count has stayed flat. The administration has positioned the conflict as a short-term endeavor from the beginning. And polling has indicated that it's an unpopular war with voters, which may also hasten a withdrawal. If the conflict drags on, we've seen that historically, as I mentioned before, regional conflicts don't generally have an outsized negative impact on markets and the economy. Global businesses have shown an ability to adapt quickly to challenges, whether it's something like this or COVID or the Ukraine war. I think the unique risk in this conflict is the potential ability of Iran to utilize its geographic location. Think about the Iraq war. Iraq is basically at the very kind of northwest end of the Persian Gulf, essentially landlocked. Iran is that whole northeast side of the Persian Gulf. Iran is 4 times as big in terms of geographic location as Iraq, has twice the population. So they're sitting right there on that Hormuz Strait, which is the choke point for all of that kind of commerce and oil moving out and fertilizer moving out. And just with the way warfare has evolved over time, the utilization of pretty cheap drones they could potentially be very disruptive in the Persian Gulf area for a long time. And that would obviously have negative impacts for oil. The estimates I've seen is if this continues on, that $150 oil is probably to be expected. So hopefully cooler heads prevail and that doesn't come to pass. With that, I'll pass it off to Tom to speak to the public debt markets.
Yeah, thank you, Greg. So first off, to address the elephant in the room, I actually requested a laptop this large. So this is on purpose.
He's a gamer.
Nothing says ready for the technology revolution. Laptop this large. So I'm just gonna speak to the credit markets, and I'm going to debt markets, and I'm gonna talk about just the changes that have not only occurred in the past week, but also have really occurred over the past month in the debt markets. Certainly credit markets like the equity markets have been affected by events over the past month, but bottom line is they remain orderly, and importantly, they remained open. At this point, just to sum it up, I would say that debt markets seem to be pricing in an inflation shock and concern over persistent inflation from these events, and really not a classic recession scare. Yet. Which in my mind, for a fund as liquid as ours, that presents quite a bit of opportunity if we do go down that path of a recession. Treasury yields have gone up over the past month. 10-year yields are now in the 4% range, low to mid 4%. Long bonds got up to around 5%, a little less than that. So 35 basis points above when we last spoke in late February. Importantly, on the short end, markets have really swung from expecting Fed cuts later this year to assigning some probability to an actual Fed rate hike by late 2026, and that's really due to concern over persistent inflation from these oil prices and the follow-on effects. Along those lines, the MOVE index, which is an indicator of volatility expectations in the market, certainly spiked. I think the highest since about mid 2024. As far as investment grade corporates go, spreads have widened 10 to 15 basis points on average. I emphasize on average, so up to a range of approximately, we'll call it about 90 to 100 basis points. But 90 to 100 basis points is still well below what we saw in prior crises. You know, when I come talking to you about spreads being okay and they're in the 250 range, then that's when you really should start doubting me. Because we're not very close to that yet. As I've mentioned to the council in the past, what is happening under the hood, you know, the broad index or the broad averages aren't really signaling a lot of concern yet, but what is happening is dispersion. You're seeing persistent dispersion between higher rated credits, lower rated credits, single A, double A's, triple D's in the investment grade markets. You're seeing that dispersion in the lower rated markets in the triple C's. And that cohort is where the market is really starting to expect that there are going to be financial strains going forward. I mentioned earlier that the market remains open. Liquidity in investment grade is really staying strong, staying pretty steady. You know, and that's really one of the first things I look for are what's going on in secondary market liquidity, and then certainly what's going on in new issuance demand. And Treasurer, I'm sure your staff is telling you that new issuance demand is it's difficult to get the allocations that you would like. 2026 gross issuance, we're looking at roughly 2 to 2.25 trillion. That's what it's on pace for, which would be very strong. And you've got several hundred billion that's already been priced in. As far as high yield spreads, they moved to approximately 9-month highs. Really, the theme here across the market is really this dispersion. Higher quality, slightly wider, high yield, slightly wider still, greater dispersion. And then in the bank loan market, the bank loan market actually has outperformed the high yield market year to date. You know, technically, there's a lot of technical reasons for that, but it has. But at the same time, you're seeing that similar dispersion in underlying credits with really that focus on the same thing that we're seeing in the headlines. That dispersion is separating out along sectors that are software technology. The market is pricing in additional risk in those areas. So I'm going to cut everything else short. I was going to say, mention something on the securitized markets, but I think we have one of the best experts in the house that we could, in Joel Holsinger. So Joel, you know, if you can speak to that. And then just to reiterate right now, the bigger picture for the credit markets is really wider initially, concerned, but really waiting to see the duration of the economic strains that are happening right now. And really pricing in, it's more of an inflationary adjustment right now than it is a credit risk adjustment. But that's evolving. So with that, are there any questions?
Any questions for Director Dunn or Director Lund? Around.
Several. As always, okay. We're spending $1 billion a day on the war. We're 39 trillion in terms of our debt, which is doubled almost. So that's got to have an impact in the longer run. That's one question. The other is about the credit markets, which you read a lot about, concern about that. And again, I'm still working with, I sent the insolvency issue that's been all over the news, which John is saying is they don't understand, the writer didn't understand about it, but just for us to understand what that comment is about from Forbes magazine. And then lastly, I still worry about unemployment. I see more and more corporations letting people go. And that's that, and the rising inflation is going to have a big impact on the economy. So
Remember, Alan, yeah, there's a fair amount to unpack there. So, if I can remind me to answer every question that you had, because there were a few, and I don't mean that wrong. I mean, I thought it was
well, and I've got another market manipulation, which I think is possibly that's been going on.
Sure.
So start with the $1 billion a day market manipulation, 39 trillion.
Yeah, so a couple of, just a few observations. I think that you're seeing some of that concern about long-term, debt load for sovereign debt load, not just with the US, but, globally. I think you're seeing that sort of, uh, what's the right word, sort of, form itself in the long end of the treasury curve. It's staying persistently high. And so what I think kind of what you're seeing is you're seeing a bifurcation in the curve, meaning that it's both ends aren't really operating together as much as they once did. The short end of the curve is really being heavily influenced by treasury issuance and the Fed and the near-term macroeconomic cycle. But the long end of the curve is starting to really be mostly influenced by concern over the amount of debt supply that's going to be outstanding by the United States. So I think that's in the first vestiges. We're in the first sort of innings of seeing that happen. Just as an anecdote, one of my canaries in the coal mine with regard to sovereign debt has always been Japan. Highly indebted. It took Japan 3 decades to ruin its currency. And Japan did not have the best legal regime in the world, and it did not have the best military in the world. We might not like how the military is being used, but it is the best in the world right now. And it wasn't the currency that everybody depended on. So it goes back to the old adage, we see this happening. We know it's going to have to be addressed. But it could be with us for decades before it really comes to a crux. Because so much of the world really needs the dollar and needs what the United States brings to the geopolitical landscape. Okay, so that's just kind of it's not necessarily driven by fundamentals per se. I know I certainly don't like it. I hate seeing it. There was a day when people spoke about future generations. Seems less sort of the topic of the day today, and I think we need to think about that when we think about our overall sovereign debt. What were the other questions?
Credit markets, the
Yeah.
concern about credit markets, and I know Mary's been on that for some time.
Yeah, so there's a lot of there's a demanded for it when you look at the investment grade debt markets and you look at the securitized debt markets, demand has stayed fairly consistent in the higher grade and the higher quality product. I think that's a product of just that there's more liquidity worldwide that has to be put to work. So I think that's a part of the demand. I think that the United States still has we'll call it a special place in the world. We call it US exceptionalism. I was at a conference recently where I actually was able to meet our new CIO. She was there, and there were multiple non-US CIOs in the market. And the consistent theme from them was that they still believe in US exceptionalism. So they still see this as the cleanest dirty shirt out there. So it's not only that there are technicals out there where there's a lot of liquidity that has to be put to work, and most of it has to be put to work in the debt markets, but also from a global perspective, we are still seen as the safest among a lot of poisons to choose from. Okay. And I'm sorry, your third. My wife gives me a
The
hard time with that one,
unemployment, inflation going up, and increased unemployment, and continued seeing corporations laying off people.
Yeah, I can speak to that a little
Yeah,
bit.
please do.
Yeah. So on the employment side, so yeah, we have seen, you see the headlines of like Amazon's laying off, Square is laying off, or Block as they're called. So in some of those cases, like in the case of Block, they tripled their staff during COVID. So that layoff was, they said, oh, it's AI efficiency. to some extent, but it's also mismanagement of the business and a slowdown in their business. For Amazon, they've been laying off in some areas and they've been adding in others in their AWS business in particular. So net, there's been some growth there. So it's been, I say that to say it's been a little tough to like see like a clear AI is causing job layoffs. I think it's certainly slowing down hiring. It's certainly making, especially in those computer science degrees, coding areas, it's making those people much more efficient, which means you need less people. What we hear from our managers who are speaking directly to companies is that it's making people who are writing code 30 to 40% more productive than they were as they start to utilize AI tools to help them do that. I think the thing to watch closely is potentially how that accelerates. There's certainly some jobs that are just going to go away, which is something that's always happened through history. That's just part of the evolution of an economy and the adoption of technology. Those things happen. The difference with AI, it feels like, is it has the potential to happen a lot faster than, say, the Industrial Revolution. The beginning of the internet era in the mid late 90s. So that brings into question, do we have appropriate social safety nets and things of that nature to kind of help retrain people, get people employed? People are starting to talk about potentially like a universal income kind of thing. So we may see, we've been talking about a K-shaped environment. Consumers, especially in the middle income and lower income ranges, are struggling. Markets are up. And the impact of AI on productivity, higher margins, good for earnings, good for stock prices, but not everyone benefits from that. And some people will really be hurt by the displacement. So I think it's a real risk out there.
I was at a conference last week with risk managers in Nashville, and a lot of it was on AI and job. And my concerns are we're not talking enough about social programs, upskilling, reskilling, but the impact, like in DC alone, there's 92,000 people without jobs that have PhDs, scientific background, computer science background. And at this conference, a lot of the people were cybersecurity, computer science, or have those backgrounds. What's being let go are high upper middle class jobs between 70,000 and 300,000 a year jobs. Would not have that in the past, and it is happening faster. It's not only that they're laying off people, but they're freezing hiring too. They might hire back in a few people that are sort of cherry picking, and then the concern about inflation and the war and the debt is also freezing that. Yet we have high profitability of number of corporations, which is why the stock market's been good. But part of that's because they've laid off people and they don't have that cost. Mm-hmm. So I feel like it's all gonna, I feel like, just as you said, we're watching this, and I think we're gonna have a drop off of cliff. And I worry that we're not thinking as a society ahead enough about how to deal with this. I'm a fan of AI. Yeah. I'm not saying it's great, and it is going to enhance productivity, maybe not as fast as people anticipated from the market, but it's really the impact on jobs. Every single person, every employee needs to know AI and work with AI. And you're right, coders or kids, nephews that are doing that are using AI, but it is going to take away many financial analysis jobs, insurance analysis, healthcare analysis. I mean, there are a lot of middle class, upper middle class jobs that are going away right now.
Yeah. You bring up a lot of, there's certainly a lot of unknowns, and I've heard multiple sides of this. I've heard, frankly, good arguments on why it's going to increase employment, as well as very good arguments on why this is just gonna really tear a hole in society's fabric. Mr. Holsinger last night, gave a lecture to some University of New Mexico students of portfolio management class. And, he was asked several, questions on how his team and Aries are utilizing AI. And Joel, if I can, I'm gonna completely plagiarize from your answer to the students. But essentially, so AI has some flaws. First off, AI wants to give you the answer that you want. And secondly, AI is it's probabilistic and not deterministic, meaning that it looks at things, it looks at situations and it says, what's the highest probability that this answer is the correct answer, or this answer is the wrong answer? And so by using probabilities and not facts all the time, right now it's flawed. It's improving rapidly, but it's still flawed. So to Joel's point, the best way to use AI and the safest way to use AI is as a review tool, not as a new thinker tool, right? And not, so it's not yet, it's good to enhance the quality of my work, but it's not good in doing the raw work itself. And that's something that takes experience, and you can't teach experience. Like what we, the market downturns, the mistakes that we've seen that on paper would have seemed like and even today would seem like a great choice or choice set, because of experience, we know that they're the wrong choices, but AI has to be taught that over time. Does that make sense?
Yeah, I understand that, but that's not necessarily what corporations are thinking when they're laying off people.
Well, I think
So I understand we're going to, what I think will be a massive disruption in terms of employment. And that will have an impact on the economy, because it'll have an impact of those people not being able to pay their bills or, whatever. So it's there. It's like the elephant in the room around this. And I do think, again, I work a lot with AI. I think that it has great promise and great capabilities, especially agentic AI. But there's the disruption that's happening in between. All I'm saying, I don't want to take up more time. But I just want us as the council.
And it's something, I don't think you were at this month's credit committee meeting, but Mary Bates gave a great overview of how our managers are thinking about this risk at companies that they have lent to. And it's something that they have been looking at frankly for years and underwriting for years. It's a lot of this now is happening in the press, but it's something that our managers have been looking at for years. But I'm not saying that to diminish the risk that you're speaking about, because I think that the rapid change, and then just to plagiarize from Mary, I know, and I agree, for me personally, I can think linearly in terms of improvement, but I cannot think exponentially. And it's a compounding effect on the improvement that's happening with AI. And it's something that we, from a humility standpoint, we have to be aware of, that things are changing very rapidly. Yeah.
Really important discussion. Any other questions?
Mr. Chair.
Yep.
I have
Member Summer.
one. Normally you see a flight to safety when you see wars going on. And could you address a correlation of what's going on in the commodities market with gold and silver dropping so drastically, Bitcoin dropping so drastically in price, and what's going on with the war, and how you think it's going to affect what we're doing?
I think the flight to safety you see in the strengthening of the US dollar. So the safest asset, as you were saying earlier, is still US treasuries.
As far as with precious metals, that's that's more something for probably our real assets director. And I don't think that, I honestly, I don't know. I wish I could tell you that it's not something that I'm gonna try to apply on, but I don't understand that well myself.
I think what you brought into prices, it might just be some of that historical inverse correlation with interest rates, kind of
Yeah, it
research.
just looks like it,
Yeah.
is what I'm saying.
Yeah, and the gold market has been so speculative. I mean, it's doubled in value the last year or whatever it is. And you know, part of the driver of that is, people moving away from US treasuries and then maybe using gold as a substitute for that. And then there's just been a lot of speculation around it. So I think as people maybe move back towards US treasuries and as much as gold has run, you know, I just saw a study recently that, you know, the move in gold and silver has been like a second or third standard deviation of that. Like it's, and I don't know if Keith has anything he wants to add, but
I did hear anecdotally that a significant amount of the selling pressure came from Asian banks selling, specifically Chinese banks selling. You know, I think when it comes to currency movements and gold in particular, from a central bank standpoint, I think we have to be cognizant that a lot of the purchasing of treasuries by foreign central banks is driven by trade. It's not that discretionary. And if you have a world where trade is starting to become more dispersed away from the US, as a central bank, it kind of forces you to then diversify your total assets. So maybe you want to buy more gold as a diversifier relative to the US dollar if your dollar trade is declining relative to the rest of the world as well. So that, you know, that's part of it as well.
Thank you.
Roma?
Yes, in your analysis, are you reading anything about the fact that we either went into this war in tandem with, or we followed Israel into it? And if we want to exit because it's unauthorized, unpopular, so say the least, so if we want out and Israel stays in, what happens to the strait?
Good question. It's a great question. I do not, and I don't mean this as a political statement at all. I do not, on the face of statements that are made, that's as deep as I go on the statements frankly, from this administration. And one thing I am aware of, that the Strait of Hormuz has to be opened somehow, or the knock-on effects are going to be catastrophic. So some way or another, I feel like they'll make it happen. I don't know how, I don't claim to know how that's gonna happen. But I think that when the top government leaders of the world sit down and they realize the knock-on effects of that being shut down, it's something that just can't happen.
and there's been ongoing conflicts in the region, right, for as long as any of us can remember and longer. So I think there could be a path back to Israel and Iran are still fighting their battles as they kind of have been continuously. But it de-escalates to a point where the strait can be reopened and some normalcy can resume in that regard. But we'll see.
Thank you.
You have a question?
Yeah, mine's quick.
Oh, yeah.
I sent an article that came out in the Wall Street Journal. Big banks are playing both sides of the private credit meltdown. Private credit funds exposure to software has come back to bite them. And then there was a portion that I wanted to know about, because I know we're invested, I believe in all three. Shares in alternative asset managers like Blue Owl, Ares, and Blackstone have dropped some 30% or more since the beginning of the year, while S&P Software and Services Select Industry Index is down 20%. Bank stocks have taken a beating too, with the KBW Nasdaq Bank Index down 8%. How does all that and that story tie in to what we just talked about in total today?
Yeah, so you texted me that article.
I did.
And my reply on that is that the debt markets are really obscure to a lot of people. It's a very complex market. And so so a lot of when when you have someone that's writing an article and they need to boil it down to a certain amount of words to explain a subject that is exceptionally complex and diverse, it just creates room for a lot of misinformation, a lot of nuance that's lost. So underneath the hood, private credit is just a wide range of products. It's a wide range of structures. The blue owl structure that is at the top of everybody's list. These are entities called business development corporations. Okay, they gain special tax advantages because they have to do certain things in any one period. They have to pay out 80+% of any income earned. They have to distribute that. They also restricted as to the types of assets that they can buy, called qualifying assets. Okay. These entities, when they're publicly traded, they're primarily traded based on their dividend yield, their distribution yield. Okay. And they have been sold to retail market, not the institutional market, but the retail market as quote unquote semi-liquid vehicles. So when their dividend yield declines, or it looks like they're maybe there's bad stories in the news or things like that, and their investors want to sell, because they can only buy a certain type of assets, and because they're having to distribute so much of their earnings every period, it becomes really stressful for them to shrink in size. So two things. One, they're having to sell assets. Likely they're having to sell assets. Secondly, at the same time, they're having to still distribute a vast majority of anything that they earned. And they're still having to buy new assets regardless of what the market is currently offering them. Okay. So it makes them highly volatile. Mary and I, from the get-go, we have avoided not only public BDCs, but BDCs in general, because of that asset liability mismatch. You have retail investors that do not understand that it is not a purely liquid investment, and so they want to sell, and they create a lot of selling demand. While at the same time, these BDCs, they own private credit loans, which are long-dated investments, and they're complex, and you can't sell them as quickly as you can in the public markets. So they have to sell them at a discount, regardless of their underlying credit fundamentals. So we've stayed in vehicles where it's institutional investors that understand the illiquidity. And so we invest for the long term, and our investment term matches the underlying assets. So there's not that mismatch.
That was Blue Owl.
Well, that's really all the BDCs that you're hearing about that are having redemption issues. They're all public BDCs, and they're all subject to this retail selling rate.
Great, thank you.
One question for Director Dunn on the monthly rebalancing. So if we kind of get to the end of the month and we're continuing to be down 6% in the US, maybe presumably more internationally, will we be able to then take advantage of that and sort of get back up to our 20% in each of those buckets?
Yep, absolutely. That's when we do our monthly rebalancings, Don's been leading the charge on that.
Great.
Since Vince has been out. And when Vince was here too, that's the main thing we're looking at is where are we in relation to our target weights?
Yeah.
And we make those adjustments on a monthly basis generally.
Okay.
Yeah.
Thank you all. You give us great confidence that you know what you're doing, and I really appreciate your answers and the depth of knowledge you have about this.
Well, thank you guys.
Thank you. Let's turn to our January performance report, and I would suggest we keep it somewhat brief. This is everything that's happened in the world. January feels a little bit like ancient history right now.
So every 15 minutes, something changes. That's. Are we, is the war?
Good morning. I know we're running a little bit behind, so we'll try to keep it brief. We're here to present the monthly performance report for January. Please keep in mind that this is a public market update only. We anticipate having the quarterly report with the private market, both public and private market update for you, probably, I would say, you think it would be next month or the month after, probably. Probably
Next month for this, with the the SIC.
Okay. Yeah, there's a little bit of as you'll recall, there's a little bit of an extra reporting lag at the end of the year because all the private market funds are having actual audits. And so typically we have that 1 quarter lag, but usually that's extended by typically a month or two. But with that, I'll turn it over to RVK.
Great, thank you, Mr. Chair, and good morning, everyone. We also want to express our congratulations and excitement, the selection of Kristen Varela, and look forward to working with her. We do have the January performance flash, but as we said, it's a bit dated. So I think the discussion though on some of the risk factors are likely the most relevant. I think it was largely covered, and the way we would categorize that is the growing risk of stagflation. So that's an environment where you have lower growth, rising inflation, and potentially increasing unemployment. And that's a really tough environment in which to invest in. Not a lot of assets doing well under that scenario. Particularly public equities and traditional fixed income tend to get beat up the most. Those are the two core building blocks of any portfolio. And as I said, we haven't had that environment for quite some time, really since the end of the 70s and early 80s. You have built a very diversified portfolio that is really an all-weather portfolio, and that leans on all the various asset classes, has thoughtful exposure to different risk factors. And in a stagflation environment, should we move in that direction, really real assets are the one area tends to perform best. Tips or inflation related bonds also tend to do well. So you have that built into the portfolio, but it would be one that is a period marked by just more challenges. So we'll stop there in the interest of time, but happy to take any questions or discuss performance.
Okay, any questions for RBK?
No, but I do have one comment, and it's right before this presentation that I forgot to mention or we didn't talk about, and I think it's really important to talk about. But can somebody go to page 13? This is like an internal SIC report. If you go, I don't know if you can zoom into the bottom right, but I'll read it for you. So 2020, 2021, the largest amount was 123 million of the contributions to severance tax. It jumped up to $1 billion, so right after COVID. And then you have the distributions going out. During the legislative session, there was a lot of comment about how there's not that much money, blah, 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 blah. If you go up to the top portion of that, total permanent fund distributions to the state, I just want to show you how extensive, if you just go back up a little tiny bit right there. If you look at that graph, it's ginormous. And we had more money go out this year than any other year, and that's because of how well the SIC portfolio has been doing. So I know we crossed our that, but that's a really important concept to mention because we're giving way more money than what we've ever given, and yet people are saying we're broke, and it just bugs me. So that graph shows proof that that's not the case, and that we've hit our benchmarks consistently and surpassed our benchmarks. And I just want to make sure I'm on that. Thank you.
Thank you. Any other comments?
May I point out just two things in the report quickly? Page 19 of your diligent. Just want to point out again, these are the three largest funds. They make up 88% of the assets. And they still had interim targets. I just want to remind the council that you are at your target, you were as of January, your target allocation to equities. But you have suspended the min and max on your public fixed income. So that's where the assets are being held to fund the privates. So when you look at this, the performance for January, the best performing funds were the ones that had equities in them. It'll probably look different when you see it next time we show you performance for the month and for the quarter. But again, just wanted to your point about rebalancing, at January, you were at your target equity allocation, so there will be room for rebalancing, and we know that Dawn's on top of that. With that, the only thing I want to point out, I just wanted to go page 38. The council members requested more information on cash, and we wanted to point out that that's in there, and I think Nino has a couple comments about that because it's something that we worked with Nino to be responsive to your request.
Thank you. So if you look at the bottom of the page, you'll see our unfunded commitments, and you see a rather large, just under $14 billion unfunded amount. One thing to keep in mind is that capital is going to be drawn down over time. Within private markets, generally you have two different types of funds. You have open-ended funds and closed-end funds. Open-ended funds typically, once they'll typically call down the entire amount within the first year. However, closed-end funds will typically draw down, once they begin investing, they draw down 25% of the commitment the first 3 years, and then, a little more there. And the total amount that they'll draw down is typically in the low 90s as a percent of your commitment. The other thing also is, to keep in mind is even in this current environment where it's a very difficult exit environment, our distributions from our existing funds are still meaningfully offsetting most of our capital calls. So if we take a look at last year, I believe we had, $3.5 billion in capital calls. However, we had $2 billion in distributions. And so on a net basis, it was only, our cash needs were only, $1.5 billion. So it's something to keep in mind. I know that when you take a look at this, that number can be alarming, but just keep in mind that, what's really needed, our cash needs is a fraction of that amount.
Great, thank you.
Thank you, and that's just the cash, doesn't even include all the short-term fixed income
that's correct.
effectively cash equivalent.
Or resilient and LGIP.
Contributions.
Sorry.
Does include the billion in LGRP.
Or does.
Oh, yeah,
That is
yeah,
zero.
yes, that is, yes.
Any additional questions?
Just to comment, I just wanted to thank you again for the good work that research you did on the proxy voting for us for the governance committee yesterday.
Great, thank you so much. Now we'll, recognize myself to give a brief report on our investment committee meeting last week. We had a good meeting. Members Roman and Tejas joined us, and the state treasurer joined us as an observer. We reviewed the capital markets assumptions from what we that we'll be hearing about later today. We also reviewed a presentation on private credit, some of the issues that Director Lofton touched on in his remarks. We did approve as a committee each of the voting items, recommend, I should say, each of the voting items before the council today. And we also, I just want to let everybody know, talk a little bit about potentially adding a new advisory member to the investment committee. We currently are down to one advisory committee member. I think the charter calls for two. So if anybody has recommendations they want to put forward, I think John Clark is collecting those.
Yes, Mr. Chair, we're going to have a very open process. We're going to post an RFI for the advisory member on our website so that anyone who's interested can send us information. So we will then work to do some initial vetting, make sure that we are then presenting the committee with a small pool of qualified candidates to consider.
Great. Any questions on the investment committee report?
Mr. Chair, I just want to mention that we had initial discussion on gold.
Yep.
Which was, not to put it in, fully not to not put it in portfolio, but to start thinking of its role potentially. And what other sovereign wealth funds and other large buckets of money out there are doing with the asset class.
Yeah, thanks for the reminder. Yeah, I was remiss not to mention that. We had a really, interesting discussion and presentation on gold as well. Okay, so with that, I think we will turn now to our first investment voting item, which is the Waterland Private Equity Fund opportunity, and Director Cassidy will open that discussion.
This month, we're recommending a buyout manager out of Europe for re-up. It's a group called Waterland that invests in small cap buyout deals. In 2022, the SIC approved a $55 million commitment to their two funds. This time around, we're hoping to get a little bit more, recommending commitment of up to 125 million in aggregate to the two Waterland funds. Their flagship fund, which is called Waterland Private Equity Fund 10, and their fund that reinvests in a select amount of their high performing portfolio companies called Waterland Partnership Fund 2. As a reminder, the buyout index, roughly 28% of the index is in Europe. We get most of that exposure via global managers that invest globally as part of their fund mandates. We occasionally do funds like this. We think Waterland is frankly the best, if not, or one of the best, if not the best groups in Europe, and we're excited to partner with them.
Thanks, Chris. Thanks, Mr. Chair. Waterland is an existing relationship in the national program with the two fund commitments. Those funds have generated an aggregate net IRR of 48% and a 1.4 times net multiple as of September 30th, 2025, which is the most recent valuation date. Waterland has an over 25-year history of investing in Western Europe, and they focus really on the smaller middle market companies. We like this focus across multiple geographies in Europe and at the smaller end of the market because we're getting broad exposure to companies, which adds to the diversification of the portfolio. In due diligence, there's several attractive elements to the fund that I want to highlight at this time. I mean, the firm has been partner-owned since inception. They're led by 14 partners who average about 13 years at the firm and over 15 years of private equity experience. And they have 9 offices currently across Western Europe, which is important because they take a local approach to their strategy. They really emphasize local sourcing so that they can be more active in the target geographies and be close to the companies that they're targeting to invest in. In addition to the investment team, Waterland has a performance improvement team, which has about 15 people. And this team focuses on value creation within the portfolio companies, and the firm plans to continue growing this team, which is an important aspect of the strategy. The strategy is a controlled buyout focus, where they find companies that they can really build through add-on acquisition. So it's the traditional kind of buy and build strategy that you hear in buyout. But they also focus on value creation improvements as well. As I previously mentioned, the fund is focused on Western Europe. And from an industry standpoint, they do invest across 4 themes, which cover a broad range of industries. Those 4 themes are aging population, outsourcing and digitalization, leisure and luxury, and sustainability. The difference between the two funds, Waterland Private Equity and Waterland Partnership, is the partnership fund is different in that it will target GP-led type situations and minority stakes in existing portfolio companies that are being realized in the main fund. So basically holding strong performing companies longer in the partnership fund. From a track record perspective, you can see in our report that the firm has invested 9 private equity funds, 1 continuation-led fund, and 4 secondary opportunities funds. And most of the mature funds rank in the top quartile against the MSCI Burgess Europe Private Equity Benchmark. So we are recommending an up to 125 million euro commitment across the two funds. And I'd like to turn the time over to Waterland.
Hopefully we have technical difficulties. Or the head of the firm is intending to join in on Belgium. Cedric, are you there?
Yes, I'm here. Can you hear me?
Yes.
Okay. Great. Glad to be here, and thank you for having me. Do you want me to shortly introduce myself and maybe give a bit of a headlines on the firm itself?
Please.
Good. So very quickly, so my name is Cedric van Korenbergen. I am the group managing partner of Waterland. I've been now 21 years with the firm, and prior to that, I had, let's say, almost 5 years of professional experience in the venture capital market, mostly software and semiconductors. And ahead of that, I also was a founder of a software firm and a consultant in the late 90s. As you already laid out, we are now almost 30 years in existence with the firm. We have roughly 15 billion euro of assets under management, and have done historically more than 1,300 investments to date, broken down in 200 plus platforms and 1,100 plus add-ons. We have grown from our original Belgium and Netherlands roots across now a network of 9 countries, predominantly in Western Europe, whilst maintaining the original investment strategy from the start, which places a great emphasis on continued focus on the lower mid-market size bracket of the market, a disciplined focus also on so-called proactive deal sourcing. So to give you an idea, more than 80% of our new platforms are sourced proactively, meaning that we take the initiative to get in touch with an entrepreneur, a founder, or a family-owned company. I think it's fair to say that we pioneered the buy and build concept in Europe almost 30 years ago, but we continue to hopefully, let's say, have a more granular understanding on how to create value with our companies as we grow. So we don't only rely on buy and build in terms of value creation, but also want to focus more and more on making sure that the deal teams working hand in hand with our performance improvement teams create value in excess of the classical buy and build playbook. What is very important for us in our model is that we have a fairly time and labor intensive approach, meaning that we are a fairly hands-on investor. So we typically have multiple people of our own investment team that work together with the management team of those companies to generate essentially the above average growth of our investments. That means that today we are, even though we have a focus on the lower mid-market, we have a team of roughly 215 people working at Waterland, roughly 2/3 investment team and 1/3 central services. And so far, we've always been a 100% independent company, meaning that we are 100% partner owned. And I will pause with this short intro to see if there's any, let's say, any questions that I might, want to clear out for you.
Okay, thank you very much. Any questions on the Waterland re-up opportunity?
I just have one, maybe there's that. So just to be clear, I just got informed by John to clarify re-up and top-up, because we're using them differently now. So re-up, this is a new fund that we're working on. The first 2 funds we did were only 45, was that 45 million or 45 euros? It was 45 euros.
10.
In 2023 with Fund 9, and then Fund 1 in 2023 for 10 million euro. And so this is 145 million or 125 euro.
Up to 125.
In a whole new fund.
That's right.
So this is a big difference. So talk to me about why we're doing it.
Yeah, we wanted to.
More, and let me add to that, you have, this is only 600 million euro in the total fund, and we're wanting to do 125 of it.
Yeah, no, it's a great question. So to clarify, we're looking at 25 million euro in the smaller fund. So it is a smaller commitment to the smaller fund, and then up to 100 million euro into the main fund is what we're targeting. And when talking about the commitment to the last fund, Waterland is a very in-demand manager. They were oversubscribed. Their last fund had more demand than what they could take. So we actually got a lower commitment than what we wanted last time. So those amounts that you're seeing from the last fund are actually lower than what we wanted to get.
Page 50, there's a paragraph in there which talks about the commitment, which is an up to amount, and then the kind of minimum allocation that Waterland's talked about with us. We would obviously like more than that. It's subject to availability. However subscribed they are, honestly. So the commitments for up to 125 million in total between the two funds, 100 in one fund and 25 in another. They've talked to us about an 80 million allocation, but split 65-15. So hoping to get more, but it's not a guarantee.
Mr. Chairman, were those total fund commitments, what were they? Were they also 600 million euros?
Oh, no, the main fund is 4 billion, of which the provisional allocation we've been talking about is 65, and we've asked for up to 100 if it's available, which it may not be because this fund's very oversubscribed. And then for the $600 million fund, we've submitted up to 25 requests, but 15 is something they think they could kind of guarantee, but it's not clear we'll get more than that.
Mr. Chair, Madam Treasurer, just to put it in context, the last fund, the 2023 fund, 3.6 billion euros for private equity fund 9, and then the partnership fund 1 was about 514 million euros.
Thank you. No further questions.
Okay, thank you. Any additional questions on water? Only we want to make this motion for me.
Based on the recommendations of the Council Investment Committee, Advisor Mercer and the SIC staff and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of 125 million euros or the equivalent of $144.25 million for the Water Land Private Equity Fund 10 and Waterland Partnership Fund 2, subject to and contingent upon the New Mexico legal requirements, New Mexico State Investment Council policy, negotiation of final terms and conditions, and completion of the appropriate paperwork.
For motion by member Summer, is there a second?
Second.
Second by the treasurer. Can we have a roll call vote, please? Is there any debate on the motion? Hearing none, can we have a roll call vote, please?
Treasurer Laura Young Montoya,
Yes.
DFA Secretary Wayne Props, Catherine Allen,
Yes.
Don Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Sommer, yes. Mary Roman,
Yes.
with 7 in the affirmative, motion passes.
Okay, thank you very much. Next, we'll hear about Aries Pathfinder 3, and I was remiss in the investment committee report. I didn't mention, the committee actually asked, Nikita and Director Lofton to go back and see if we could potentially upsize the original contemplated commitment of $300 million, to try to, close some more capital and get more exposure. So they're going to, that as well. Director Lawson?
Yes, sir. So thank you, Mr. Chair. I think we're on page 150 of our materials. Staff is recommending a 300 million total commitment to Aries Pathfinder Fund 3, structured as a 250 million primary fund commitment plus a 50 million co-investment allocation. This is a re-up, meaning that we have invested in the prior fund, Pathfinder 2. We are requesting investment in the follow-on fund, Pathfinder 3. This is Aries is a flagship asset-based finance strategy, which means it is focused on lending against pools of loans, leases, receivables, and cash flowing assets. I have with me on this presentation Mary Bates from Nikita, Avni Gandhi from Aries, Karina Chaubert, I got it right. Also from Aries, and then Joel Holsinger from Aries as well. So first, I would like to go through the merits of this recommendation from an investment standpoint. But then secondly, Treasurer, I know that you had some very specific points that you wanted addressed, with Aries. Had a great conversation with Aries last week, Indira Arrington, who is head of their, diversity, equity, and inclusion effort. She is out of the country, so she was not able to attend today. But in her stead, she sent Johanna here, to speak to those topics. Aries also made a point of offering to all the council members and you in particular, treasurer, if you want an offline meeting to really go into a granular level across the Aries platform and across all of their teams, that they're more than happy to walk through those with you and explain to you their efforts for addressing and creating a more diverse firm with more diverse backgrounds. Third, Mr. Chair, you're correct. CIC did ask for a larger investment. We can address the co-investment sleeve as to, why this commit would be an improvement over the prior commit. Unfortunately, this is a first for me. Probably not a first for Mary, but the Pathfinder fund is at least 2 times what oversubscribed.
I can't comment that.
It is highly oversubscribed, and we were too late. There's significant interest in this. I know private equity experiences this, but this is a first for us. Frankly, Barry and I debated quite a bit over the appropriate commit level for Aries. And we weighed, frankly, the attractiveness of the strategy versus our overall Aries exposure at SIC. Plus, we also weighed, when we look at our larger exposures, we wanted to be relatively consistent in the size for any large exposure. And we've generally hovered around the 300 million. We have a few that are larger. Given the growth in the SIC, you're gonna see us coming forward with even larger commitments for those investments that can deploy at scale, like Aries. But unfortunately, this time we were too late, and that's, I take responsibility for that. And then fourth, 2 key differentiators with this strategy. It has the ability to rotate across a broad range of investment types to truly take advantage of relative value. And it has the scale to write large checks. So when we get to Aries, I'm going to ask Aries to, there we go. I'm going to ask Aries, Joel, if you'll just kind of go straight to answering questions. Sure. Because I think Mary's going to give it a good overview for Aries. And I think that, many of the relative value questions that council members asked before, Joel was really in a great position to talk about the range of investments that they could go into and what they're choosing to avoid versus what they're looking at right now from a relative value standpoint. So quickly, why does the strategy fit into the SIC's portfolio? It allows for significant diversification from standard corporate loans. There's a material yield component to the returns. That's a priority for the private credit allocation. The size of the fund, the size of Aries allows it to commit capital at scale, which does give it competitive advantages in the debt markets. It has a predominant focus on amortizing cash flow investments. And as I said, it can be opportunistic to take advantage of dislocation. One of my favorite investments were the bank portfolio investments that you made right after Silicon Valley.
It's actually in the back of the deck in one of the case studies.
So real quickly, Pathfinder strategy, Pathfinder 2, I think it may be our highest performing fund. I think you're sitting at a net 17%.
Through the last report again.
Yep. With fee breaks and the co-invest sleeve, there's very good economics in this recommendation on a blended basis. And then, this investment addresses what is essentially a $28 trillion addressable market. So it's a broad It's a very broad addressable market. So with that, I'm gonna turn it over to Mary.
Great, thanks, Stephanie. I'll also keep my comments brief, and I would say that you're probably, we're very fortunate to have Joel here, can address a lot of the questions that have been raised in terms of the broader, industry as well. And share perspective on that, but so Ares Pathfinder 3, this is an opportunistic asset-based credit strategy. It is focused on downside protection while capturing upside potential. It's targeting 11 to 15% on a net IRR basis and 1.5 to 1.75 on a net multiple on invested capital basis. It's a continuation of the Ares Pathfinder closed-end series, employing the same strategy and approach. Let me, as I typically do, I'm just going to quickly walk through some of the strengths that we identify with this offering, as well as some of the concerns and mitigants associated with it. As already highlighted by Tom, we appreciate the breadth of the strategy employed by Ares, ranging from fund finance to equipment leasing to residential mortgages and beyond. This is one of the broadest opportunistic asset-based lending strategies in the market. In addition to that, it's paired by the structuring expertise of Ares and the relative value approach that is core to the GP's approach, coupled with the flexibility of capital that it offers to its borrowers. The scale of the Ares platform is also a key differentiator, with over 100 investment professionals dedicated to alternative credit. Ares is one of the largest asset-based lending teams in the industry. Additionally, the GP can leverage the broader resources of Ares, the organization, which is one of, if not the largest private credit GP in the industry. That allows the GP to be a sole or lead lender on nearly 100% of its deals, resulting in a differentiated portfolio. The manager also has one of the largest asset management capabilities in the industry, which it has allowed it to avoid some of the recent headline related ABL issues. The performance of Pathfinder, I think, speaks to itself. The GP has limited losses while capturing upside potential, which is consistent with the return profile of the fund. It's experienced less than a basis point of realized annualized losses since inception. Both vintages are returning in line with expectations. We would further highlight, while we are disappointed that we were not able to secure a larger commitment size for this commitment, we appreciate the manager's discipline as it relates to fundraising, and would highlight that they are actually targeting the same raise that they did last time. We're sure that they could secure additional capital, but appreciate the discipline and identify that actually as a strength. We would further highlight that we appreciate the lack of affiliation with an insurance company, and identify that as one of the differentiators. We would further identify the vehicle structuring and the unique vehicle extension optionality that is provided in this vehicle, which we'll let the GP speak to in greater detail. Some of the concerns that we would highlight is this is a complicated strategy, given its breadth, given its flexibility from an implementation standpoint, and given its flexibility across the capital structure. It does make it difficult to, it is the antithesis of a direct lending fund in terms of the clarity and the succinctness in terms of describing it. That said, we would say that the manager is incredibly transparent and very accessible. They provide quarterly updates. They're accessible to us whenever we want to talk through deals, and provide strong granularity in terms of position level transparency. We would highlight that this, while there is a strong yield component, as Tom alluded to, there is a meaningful PIK component to that, so we would highlight the cash pay component, and also you should appreciate that there is a meaningful structured equity or preferred equity component to this. There are downside protections associated with that, and we'll let the GP speak to that. But happy to take questions, or happy to turn it over to Ares.
Thank you very much. We said you were going to go straight to questions, or
We can go wherever we want to go, whatever you recommend.
okay. I'm happy to move straight to questions if that's good with the members. Okay, are there any questions?
I do.
Go right ahead.
And I wasn't there for that part of the meeting when the idea of the larger commitment, FYI. But I do wanna know, so Aries has come several different times. We've invested about close to $2 billion, correct? And at that time, we had a smaller portfolio. We were about 58 billion, I believe, around the time I met you. And so, so a couple of thoughts. We've shifted a lot since the 3 years I've been the state treasurer. And at that moment, when we had a conversation, I had a very honest conversation with Aries about the idea that they agreed that they needed to increase their diversity, especially in the top tier of their investment professionals. And there was a commitment made to me, I don't know if you remember this, that there would be a shift the next time you guys come before us. And so I pulled all of my stuff yesterday from several of our commitments all the way back to 2019. But I wanted to hear from you about how that shift has occurred. And let me explain also why. One, I didn't forget because it was when I first started and I was really shocked that it was basically all just men. And I truly believe that it mitigates risk when you have a diversified team. And I've heard great things about you, FYI. So this isn't I'm not picking on Aries at all. And for full transparency, I met Indira because Indira is also, she was at the Milken recently when I got invited. She's on one of those boards. And then she was also the moderator at a CUP at the Aries building. I've been to the Aries building in California, actually. And I've been invited by CUP this year to be a panelist. So that's the full transparency on that end of it. But I know that there has been conversations just in the industry about pulling away from diversity and not celebrating it and not being able to see that it actually mitigates risk and that data shows that you usually get about 6% higher. And so I saw some of the numbers on here and it didn't seem as much of an improvement as I was hoping for, especially because we've invested so much in Aries. And I know your portfolio is great, your fund is great. But I think it could even be greater if we can continue to go in that direction. And I wanted to hear from you all, because I know you're hearing from other states in a different concept. They don't use the word diversity. I think you've heard diversity this morning probably like 25 times, because we're a majority minority state. We embrace our diversity of culture, of thought, of everything under the sun, including our chili. So I wanted to give you a perspective of that and see what your thoughts were on all of it.
Sure. Why don't I start off, and then Kahina can fill in with regards to some of the stuff specific related to foreign and corporate standpoint. But as much as I know this topic is near and dear to your heart, it's also near and dear to my heart in a different way. And one thing we did not highlight with regards to the overview of the fund, and I believe it's here in the back, page 14 and 15. Sorry, I don't know the page numbers relates to the broader, but it is, I think everybody always has, we were talking about it last night with regards to the class, everybody has their own set of experiences, everybody comes from different places. I grew up out west, I was born in Eugene, Oregon, I went to high school in Boise, Idaho, I'm a Fort Preachers kid that I did not know this world existed in any form or fashion. And stumbled backwards into this world because I was good at math and science and changed from engineering to other things. The reason I say that is that my wife and I, we met 28 years ago. And shortly after we got married and we started to have some success, we decided that we were going to give basically everything away to charity at some point. It was easier because we didn't have much, because it was at that stage of our marriage and other things. But her dad was originally from Peru. She was a second generation immigrant. And she also was aligned from the standpoint of, one, we wanted to raise our children in a way where they had that same grit. And we also wanted them to appreciate what we were trying to do. The reason I say that is when I joined Aries 7 years ago, I had a specific ask that had nothing to do with asset-based finance. And what that ask was I wanted to tie whatever I did next into charity. And so what we came up with after a lot of back and forth, and Mike Garaghetti, who's the CEO of Aries, I've known him for 20 years and is a very good friend. And I said, I'm yours if can asset-based finance, but have a charitable tie-in. And what we've done, we have been a leader or a pathfinder with regards to this strategy, is at least 10% of the promote of Pathfinder 1, Pathfinder 2, Pathfinder 3, as well as 5% of another commingled one we run under the Pathfinder name. Of that promote goes to charity. It goes to health and goes to education. Half of that comes out of Aries. I actually co-chair the Aries Charitable Foundation, which we started 5 years ago, back on the back of what we've done from the Pathfinder family of funds, along with Mike Arrighetti, and it's ran by Michelle Armstrong. We've done close to $50 million plus of grants in the last 5 years. We talked earlier today about education and reskilling and retraining. That's our first initiative. Then it's financial literacy, and then it's effectively economic empowerment and entrepreneurship. On the health and education side of things, we've already accrued just in the Pathfinder family of funds, just with regards to what we've done to date, over $50 million that will go to health and education charities. If you look at Pathfinder 1, 2, and 3, that effectively starts to kick in, not yet, but with regards to our other fund, we actually did $4 million of grants this year, just out of that other fund, which went towards health and education charities, which includes things like building surgical centers in Zimbabwe, as well as stuff across US and Europe, as well as things across India and others. It's focused on women and children. That is effectively the whole thing. The reason I say that, because I think it goes to, one, I was driven by, my mom was a nurse, my aunts were nurses, my grandmas were nurses. My dad was a pastor and he was going to India in the 70s and he was going to South Sudan until he got diagnosed with Parkinson's 3 years ago. Nothing means more to me than from the standpoint of meritocracy, and meritocracy only occurs if you have health equality and you have education equality. If you have that ability to do, whether it's in the US or whether it's on a global basis. I look at the American dream is effectively health equality and education equality across that. So with the back of this, if you look at it, the average life in global health is about $3,300 to save a life. And if you think of that $50 million plus, and that's only where we are now and what we're accruing, it is something that I don't think you can say more from the standpoint of putting money where your mouth is, when I'm literally putting money where my mouth is with regards to what we're doing here. And I think it's something that not only have we done it from the Pathfinder family of funds, but we actually launched a program October 15th of last year, where you can see on page 15 on our deck, we got Pretium and Collar and Silver Point and as well as Related and Pantheon and others to also agree to give 5% of their promote to philanthropy. Something that's coming out of our pocket, and I look at it as a dual purpose. On one side, we're driving the highest returns to what you do, and a lot of that is driving pensions and endowments and health and education. On the other side, out of our pocket, you're driving those dollars to philanthropy. And it's something that we're hoping does become an industry initiative, because in the end, it drives the ultimate equality. It drives the equality across all these programs. Not everybody's going to agree on the same on health and education. Some may do it towards homelessness, some may do it towards climate, some may do it towards other initiatives, but it allows everybody to have that mechanism to kind of do that. So I just wanted to hit that just from the standpoint of, one, anytime I get a chance, I like to talk about what we're doing on a philanthropy basis, because I look at it from the standpoint of the only way that becomes an industry initiative is not me telling that story. It's you asking for it. It's you asking every GP who sits in front of you, why have you not joined Promote Giving? Because it's a very easy ask. It's one fund or fund series across that. And it's something that we do think is just doing the right thing to kind of drive that health equality, drive that education equality, and drive that philanthropy on a longer term basis. I'll leave it over to Kaina with regards to some of the other.
Thanks. Thank you for having me. I just wanted to start by saying New Mexico means something very special to me. I actually graduated from high school here in Montezuma, New Mexico at the United World College. So this is somewhat of a homecoming for me, and I'm grateful for the opportunity.
Now you just kind of.
I'm sorry. I had to make the connection.
I will say one thing. I always love coming to New Mexico just because when you've grown up out west, you get to get really amazing Mexican food. And so I've already done breakfast, lunch, and dinner that I'm working on. The only thing I will say though, is with regards to hospitality, it's not very hospitable to have a scale in your bathroom. Around the corner, so, but sorry, go ahead.
And thank you for the points that you made earlier about diversity, equity, and inclusion. At Aries, we do believe that diversity, equity, and inclusion are integral to our culture and success. By leveraging diverse backgrounds, perspectives, experiences, we do believe that we can create better outcomes for our investors and employees. And to that point, our Indira Arrington, the Chief Diversity, Equity, and Inclusion Officer, reports not only to the global head of human resources, but also to the co-founder and CEO, really ensuring that our strategy permeates across the organization and remains a strategic focus. We seek to harness the power of difference to be a force for good and contribute to the long-term success of Aries, the companies in which we invest, and the communities in which we operate. And when we look at our framework, it is comprised of 3 pillars: people and culture, business and investment process, and communities. We think by organizing the work in this way allows us to operationalize diversity, equity, and inclusion in a way that's practical and scalable across the firm. So starting with the first pillar, our focus is straightforward. It's about access to talent, it's about fair processes, and it's about creating inclusive environments where people can perform their best. We think expansively about where we source talent, leveraging partnerships such as Girls Who Invest, Out for Undergrad, the Hispanic Scholarship Fund, just to name a few, to really help us brand ourselves as an employer of choice and help drive talent to apply to open roles at the firm. From an engagement perspective, we have 14 employee communities that are voluntary and open to all employees at the firm. Those communities are focused on learning, community building, and professional development, with nearly 50% of the firm participating today. Just to name a few examples, it includes ANU, our women's network, Unidos, our Latinx network, our veterans network, and GROW, a community focused on mental health and well-being. Moving to the second pillar, business and investment process. We treat diversity, equity, and inclusion as a value creation and risk management lever because we think it improves decision quality, strengthens human capital execution, and reduces reputational, regulatory, and litigation risk, all of which supports risk-adjusted returns. And those principles extend beyond investing to how we operate the firm day to day. And then on our third pillar, communities, this is really about industry engagement and philanthropy to drive a broader impact. Our employee communities direct funding annually to mission-aligned nonprofits, which really allows them to meaningfully engage in causes that they care about and contribute to the broader communities where we are. Jill touched on some of our impact from a philanthropic perspective, but that's a quick overview of our strategy. And taken together, we think our approach is thoughtful, disciplined, and value accretive, and is designed to strengthen our people, our investment decisions, and the communities we're a part of. And we'd love the opportunity to schedule a follow-up conversation to dive deeper into some of your specific questions.
Great. Mr. Chairman, see, it's good to ask questions because I think a lot of people in this room might have not known that is what you're doing. I did know about the philanthropy work. In fact, that was why I was very supportive the last time with the commitment to move diversity, equity, and inclusion forward. A lot has changed since then. A lot of different people in the industry have been stepping back from even just utilizing those words. As far as your investment, top executive folks, what has been the percentage increase or has it shifted at all in your diversity? And I mean, in any realms, whether it's gender, whether it's working from the north, the south, the east, the west, like anything that helps you to have different thoughts at the table to help mitigate risk.
What I would say is diversity of thought is an invaluable asset, and we really are committed to driving diversity in all of its forms to Aries and retaining that top talent at the firm. But with regards to your specific questions about percentages, we'd love to dive in our deep dive on that.
And I'd say broadly other areas to think of, even with regards to our group. I mean, over half of our group is first and second generation immigrants. Close to half of our group is effectively racially diverse. So again, there's areas we're underweighted, there's areas we're overweighted. If you look at that, that's for a very specific reason. I said this last night when we were talking in the class, which was the first question I ask every time I ask an interview for the last 10 years is, where did you grow up and what did your parents do? I'm looking for grit. And you get grit through first and second generation immigrant. You get it through sports. You get it through, low socioeconomic. You get it through those areas and proving that you can go through. And so our team is very heavily towards that. So I do think that if you think of diversity of thought, we definitely have diversity of thought across the entire team.
And I would say you've pulled a lot of presentations. Those represent lots of different teams at Aries, and we'd love to go through each of those with you individually in the deep dive to make sure you understand each pillar of Aries as well as overall.
Thank you. So I really appreciate everyone's indulgence, and I know it took some effort for all of you to come down here to talk about this. But I think you're a leader in the industry with the amount of money that you're making on your net IRR. It's high performing, one of the top leaders on that end. The philanthropy work that you're making other people do, and I say making because when we strive for excellence, other people want to choose excellence. And so just bringing that up as another question for us to be asking on how are you investing in our communities or how are you investing in whoever, I think is helpful because you can get net IRR and you can also make a difference and you can be valuable in more than one way. For me, bridging the wealth divide is something that I also think about. And I think that Aries, being that I went to your building, being that I've met some of your folks, the leadership that they take on different boards and councils that throughout the nation, I think is influential in a way that is so meaningful to change the narrative of what we're hearing right now in our industry. And so that's why I wanted to bring this up, and that's why I wanted to thank you. And you get to be here on one of our biggest historical days. So thank you, Chairman.
Thank you for having us.
Yeah, and I would say thank you for presenting to the UNM students as well. I mean, that's just, that in and of itself, I think is a great opportunity
Yes.
for our young people to learn about the industry and career opportunities.
It's interesting, Chairman. I came from a very, not only from with regards to Boise, I went to Cal State Fullerton. I'm the exception, not the rule in the industry. It was funny, I was looking at it before I presented, and Cal State Fullerton is about 55% Hispanic. New Mexico is about 55% Hispanic. If you look at it, why do you go? You go because effectively it's state and cost of capital and other things. I got into other schools that I couldn't afford to kind of do. So honestly, I thoroughly enjoyed it, just from the standpoint of it was kind of a going home, from the standpoint of being able to remember myself when I was 20 years old, sitting in that classroom and wishing somebody had come to me and kind of talk about these things. So I thoroughly enjoyed it. So thank you for having me.
It's awesome.
One last comment. I'm from Las Vegas, which is where Montezuma is
Yeah.
located. That little area under where the hot water is that you guys probably enjoyed, that little church with the eagle.
Oh, yeah.
That's where my mother's whole family is from. So
Oh, wow.
yeah, you weren't too far from one of the best places. Thank you, Chairman.
Absolutely. I did have one question, sort of a two-part question, just on page 11 of the presentation of the portfolio. Can you just give some examples of the diversified financials bucket, like what would be in that segment? And then the second piece would just be, when you look at all of these segments, they're all quite distinct, and obviously you've got a large team. Do you sort of, the members of your team specialize in certain sort of sub-segments of this, or how do you manage to keep all of it straight from that?
Yeah, it's a great question. I'll go to it in a couple parts, which is, so one is if you look at actually, if you look at page 23 in our presentation, this is we included here on page 27, our lessons learned. This was one of the things I covered, and I've done this with Emory and I've done this with NYU and with Northeastern, is the kind of the lessons learned, which I started doing 15 years ago for a class. And if you look at that, our number one lesson learned is investing in pattern recognition. Our pattern recognition is page 23. And the reason I say that is it goes down to default curves. It goes down to that. Because in the end, if you're thinking, Pemberton will present later about corporate direct lending, you talk about default rates, you talk about recoveries. In our world, it's actually a triangle you see on the bottom right. It's not just default rates, recoveries, or severities, but it's also net interest margin. And the reason that's important is what you're really looking for is whether you're looking at equipment leasing, as you see here, or prime consumer, you want to be able to run scenarios that are 2x worse than what you're kind of expecting, and you still protect the dollar. So as was mentioned earlier, we've invested close to $80 billion with less than a single basis point of annualized loss. That comes from protecting the dollar. In credit, you don't get measured on your wins, you get measured on your losses. And that's really what that's true. So when we look at those different asset classes, they look very similar to us, because in the end, everything we do is in the asset-backed securitization market. We're just doing it on a direct basis. So not too dissimilar than direct lending, where you're doing it with regards to the leveraged loan or the fixed income basis, you're doing it on a direct basis. The difference is we call our newsletter In the Gaps, and everybody's available to look at that. If you look at that newsletter, what you'll see is the liquid part of our market, the banks and insurance, they're in the box. They basically have to buy things that fit regulatory capital. And the reason you see the market right now be relatively wholly uninteresting when it comes to that part of the market, because spreads have compressed so tight because of flows, because of unnatural things that are occurring in that market. We see the opposite in our markets, that ability to create credit, that ability to go through. But what you'll see is, to give you an example of like diversified financials to your question, is there's actually a case study in here that would fit that category. And Tom mentioned it as one of his favorite deals, which is PacWest Bancorp. It's often forgotten in the middle of war, in the middle of all the headlines, that we were only 3 years ago where we had 3 of the 4 largest bank failures in the history of the United States. And they were all perfectly healthy banks. Banks are always a little flawed from the standpoint of they borrow short and lend long. There's been a lot of focus on things across private credit and others. The thing that's lost is banks are 15 times leveraged to 20 times leveraged, and they borrow short and they lend long. Insurance is generally 12 to 15 times leveraged. And private credit is either 0 times leveraged to maybe 1 to 1.5 times leveraged. And so when you think of systematic risk, it always sits within banks because they're always mismatched on their assets liability. If you guys were running that, you'd say, wait a minute, somebody could come in here any day and call the entire SIC. You would sit there and invest only short. Banks are lending long. And so when we look at that, what happened was out of that crisis, out of that regional crisis, a number of banks got very scared they were next because there was just runs on banks, runs on deposits and other things. PacWest was one of those. And we were able to buy a portfolio below par and very interesting. But it's worth stating when we talk about, Tom was talking earlier on the market, he kind of gets a little excited about the opportunity set if it changes. And with regards to where you guys are positioned, I don't think anybody gets more excited in the industry than I do when it comes to dislocation. We do really, really well in dislocation because the liquid part of our market becomes illiquid and trillions of dollars trickle down into our world. And what it does is our playbook is really simple. You go up in quality, you don't take the same risk and get higher returns. You take less risk as you're doing that. You go to first look to the liquids, then portfolios, then you look at rescues, then you look at other things, managers. But what we were able to do is react very quickly to that. So diversified financials include, like this portfolio we did with PacWest, they showed us a close to $4.5 billion portfolio over 70 names. We cherry picked it down to 56. Every one of these single underlying assets was what we call lender finance. It's the lending to you, across whether it ends up being consumer, whether it be timeshare loans, whether it be everything we do, they were all in this underlying portfolio. And we were able to buy that portfolio in a diversified financial basis. And we were able to get those front loaded cash flows. You can see on page 21, we actually did better than what we modeled with regards to those cash flows coming in. So it's a little bit of a catch-all because you get some things that cross these sectors. And if you look on, say, page 20 on the upper left, you'll see that's just a sampling of some of the underlying assets that were in that. So it wasn't hospitality or asset manager or residential real estate. The answer was all of them in one portfolio. We've actually fully exited this transaction now above what we modeled. But it really does I think it's one of the greatest examples of what we can do. When we get tiny short windows of dislocation, we look forward to slightly longer windows of dislocation.
Got it. Okay, thank you. Very helpful. Any additional questions for Aries? Okay, hearing none, I'm happy to make this motion based on the recommendation of the Council Investment Committee, Advisor Makita, SIC staff, and general fiduciary oversight from RBK. I move that the State Investment Council approve a commitment of up to $300 million to Aries Pathfinder 3 Fund LP, with at least $50 million of that commitment allocated to a companion LP military interest co-investment structure. The commitment is subject to contingent upon the Mexico legal requirements, New Mexico State Investment Council policy, negotiation of final terms and conditions, and completion of appropriate paperwork.
Sorry.
We have a motion and a second. Is there any debate on the motion? Hearing none, could we have a roll call vote, please?
Treasurer Lori Montoya,
Yes.
Catherine Allen,
Yes.
John Daman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer,
Yes.
and Mary Roth.
Yes.
That's 7 in the affirmative, motion passed.
Thank you. Thank you very much.
Thank you.
Okay, we will now move on to item 3D, Pemberton Structured Credit Fund 4. Upsize.
All right, thank you, Mr. Chair. I believe this presentation starts on the recommendation, start with page 260 of your materials. This recommendation is an opportunity to expand our relationship with Pemberton. The manager that we committed 150 million to back in August 2024. The main fund, which is Strategic Credit Fund 4, is currently tracking approximately 14% net.
16.
Okay, 16% net. Which is definitely within our return expectations. You almost beat Joel by 1 percentage point. Co-investment proposal would bring our total exposure to SCF4 strategy to 250 million. With me from Pemberton for this recommendation, I have Scott Hamilton and Ben Golfer. And then when we get to your point, I'm just going to ask you to just speak to the difference in what's going on separately in Europe right now relative to the US. Just quickly as a reminder, Pemberton is a private credit investment firm headquartered in the UK. The firm is 40% owned by Legal and General Group. It's one of Europe's largest insurers. Pemberton currently employs well over 200 professionals, and the firm manages well over 44 billion euro in financing to European mid-market companies across capital structures. To reiterate, I think with the this is an add-on investment, and it's a pure co-investment vehicle, which makes our blended economics I'm going to say really good.
Very good.
It aligns with our private debt allocation strategy because it provides exposure to the European middle market credit through flexible capital solutions. The strategy targets predominantly senior first lien loans, 75% of the portfolio with significant equity cushions, 40 to 60% underneath. But importantly, it maintains opportunistic flexibility across the capital structure. I'm going to skip the next couple, and I think, frankly, I'm just going to go. Essentially, the co-investment is structured with it's essentially an evergreen term, so that it can reinvest capital as it goes. The best way to explain it is that it's going to enter into investments at the same cadence as its main sister fund. So if we stay in SCF5, it'll flow and reinvest alongside SCF5 investments. If at any point in time, let's say we decide not to go in SC5, the SC4 investments that it's paired with will just roll off and distribute as they mature, similar to the SCF4 investments. But it's set up in that evergreen structure so that we can take advantage of reinvestment and compounding over time. So with that, I'm going to turn it over to Mary.
Great. I'm going to keep my comments very, very brief. This is an existing investment for you. So effectively, all we're looking to do is increase the commitment size and do it through a fee-free co-investment strategy. So just as a very, very quick reminder, Strategic Credit Fund 4 is a capital solution strategy focused on Europe. It is focused predominantly on the senior part of the capital structure. We do appreciate that focus. So generally speaking, when you invest with capital solutions managers, you expect more flexibility across the capital structure. This fund does have that, but the GP has indicated it has to date focused more on the senior part of the capital structure. We would highlight that they are one of the early entrants to this type of strategy in Europe. They did have some lessons learned from previous funds, which we had highlighted in our earlier due diligence. But let me stop there in the interest of time, turn it over to the panel.
Great.
I'll start just briefly to say thank you. It's been about 1.5 years together where we were working together, and to the chairman and members of the board, we appreciate the support and hopefully the partnership with Tom and Ryan, as well as Mary Bates. We communicate pretty frequently. This has actually been second time to Santa Fe just this year, so we come over quite a bit, and so I'm based in California, and I'm sort of your day-to-day contact on transparency, investment, and things like that. And then Ben is the senior portfolio manager as well as co-head of direct lending for the firm, and has been a long time.
Great. Well, thank you for having me here, and I concur the Mexican food here is definitely better than we get back in London. So I guess, yeah, it'd be remiss of me not to comment on a couple of things I heard before being in a privileged position. We did underperform them by 1%. You're right. However, we do that unlevered from 75% senior secured first lien. So not all returns are the same, I would argue. So we're pretty pleased with our numbers, and I'm sure they would be on that metric as well. So it's great to be here. But I think, rather than, as Mary mentioned, and Tom, you guys are already in the fund, as it were, and this is a way of us giving back to you in terms of the co-investment, as we recognise the incredible and important relationship that we'd like to build with you. So I think some of the areas that may be more of interest is really bringing out some of the topics I was able to listen to and give you a comparison of Europe versus US. Because, a couple of things I would say, the word private credit is in the press a lot. But I would say if you went into a pharmacy and asked for some pills, you could get quite a diversity of offerings given to you. So I think you need to dig a little bit more deeper into what private credit really is. And as we've talked about, the fund that you're in today is opportunistic, primary senior secured first lien debt, unlevered, which is very different to what you're hearing in the press. So the first thing about Europe, so this isn't a pitch on Pemberton, but on Europe versus US, we don't have BDCs. So a lot of the press that you have, a lot of the, I would say, disinformation, as Tom correctly alluded to, is really based on, and I think the last comments were very accurate by my Aries peers, which is, short-term money with long-term assets. So when you have retail moving into assets that are very much fixed term, when they all try to exit, they can't, right? So that is something we don't actually have in Europe. What I would say is, increasingly, we've seen deployment of those vehicles come to Europe. We've seen the leverage capital come to Europe from the US, and increasingly we've seen the retail money coming via these instruments into Europe. Now, not that anyone wants to be, smiling during adversity, but we are very happy to see that capital leave Europe, because that has been very much, certainly at the upper mid-market level, not where we are today, but the upper mid-market, a key factor in deterioration of term quality and pricing. So, I'm pleased to say that hasn't infiltrated our market today, but that step back from the US is definitely a positive for Europe, which is not captured in any of the press that you will be reading. We don't have BDCs, as I've already said, and they've grown materially in the US. So, 17 times their original scale, again, doesn't even exist in Europe. Retail capital that has been coming into the private credit markets, again, doesn't really exist in Europe. So, a lot of the things that you see, the shadow banking, the lax statements from, I think, Jamie Dimon on cockroaches, they were actually funded by banks, not by private credit firms. Yes, there was elements held in private credit firms, but it was predominantly by banks. So there is a lot of disinformation out there. Not all of it is unmerited, but it is very skewed. And I'm pleased to say very, very little relationship and contagion to Europe. Software is a key topic. So a lot of the discussions earlier on, Kathleen, I think you mentioned around job loss, and what that has on the impact to the economy. Actually, the war is very much an oil energy. And as you know, at the moment, with the Straits being cut, it's estimated around $1.5 million extra is costing in insurance, crew, and time that it takes to go the alternative way around, not going through them straight. So, that is definitely inflationary. But the first sort of jars that we've seen in the economy, again, was very much stimulated from the US, from the equity markets, on concern in software. There is a feeling that is significantly overdone today, because you can have AI technology, but to embed it into an organization actually takes quite some time. I know I'm going through a torturous program at the moment called Data Camp, which is about 64 hours that we have to complete in the firm, so we can go through and make sure that we embed it into our firm in an efficient manner. So it will change the way we work. I believe it's, as Tom said, it's going to be an enhancer to what we do. So, all those manual tasks of running through documentation or being able to scrub here groups, we can do that really efficiently now without having to hire 7 more analysts. So that, from that standpoint, yes, it is going to have an impact, but it also empowers and charges the people that we've already got in those seats to make them increasingly effective. So I think the software is one of the things that I think has hit the financial markets really hard. Again, not a market that is very active in Europe, and not one that we have participated in at Pemberton, because they tend to not be cash flow focused. For you to invest, and some of our peer group have in software, it really means you're doing AAR type transactions, annual revenue transactions, where you're taking a view of what the company's going to be worth in the future, rather than the cash flow they can afford today. We are very boring cash flow lenders. If they don't have the cash to pay our debt, that doesn't really work for us. And for many cases, software companies fall into that category, which is why across Pemberton we have less than 1% in all of our funds exposure to software. That is not uncommon in Europe. So I think there's some very key sort of themes here that is probably worth sort of playing out here in this room. What is definitely going to be an impact to our economy is oil prices. As you've heard, from 65 to up to 110, and we're hovering around $100. The longer that stays outstanding, the longer we're going to see inflationary pressures. What I would say is this isn't the first time we've seen that. So, we are quite pitch fit in Europe now, with multiple things going on across the economy where we have to find workarounds. So, that is, it's not our first time where we've seen an event mean that we now have to, from a European basis, have to work around that. So I think it will depend on how long the conflict remains and how long that disruption lasts. But I think that is a more immediate concern to the economy than perhaps even AI is at the moment. The other thing I would point out is interest rates. Double-edged sword, because we were all predicting in Europe two more cuts of 25 basis points in rates this year, and as in the US, I heard as well, was also expected to cut. I'm not an economist, but I'm not a big believer in that we'll actually see hikes. I think it's a bit too early to say that we're going to see. I think it's too priced in to Europe, which I think is too much. But it certainly means we're going to have higher for longer. So the negative is that means that you're going to have a slowdown, and you're going to have an effect that is anti-growth. On the flip side of that, we are making investments where we get a higher return while rates remain high. So what you really care about is your predicted loss given default. So given that we, unlike the previous group, we focus very much on cash flow payments. So we are cash pay. If you look at our return, 82% of what we generate is all in cash. So that PIK element doesn't exist. So I'd also say it's a slight uptick on the 18% versus 17%. But ultimately, that is, and that affords you significant downside protection during volatility. So getting your cash back, lending to companies that can afford to pay your interest, are hugely important, and that is what I think we bring to New Mexico State as a diversifier, but also a heavy cash flow diversifier across the funds. So I'll stop there and ask if there's any further questions on any questions around Europe or the private credit universe in which we operate.
Thank you for those comments. Any questions for Pemberton?
I have a question, Mr. Chair. Just out of curiosity, we talked in the investment committee meeting about vintage years. So some years are going to come back to bite you and we don't know it. What vintage year is 2026 in the early stages looking like for 2026? Is this going to be the vintage year in Europe?
That's a great question. So if I look through the vintage years, and I think I even said this when I last come here, and I didn't have a name for this vintage, but I guess we've got another war now. Because if I look at vintage one when we deployed in strategic credit, it was like a benign borrower-friendly environment, very tight, and was able to achieve double-digit net returns from 75% senior secured, unlevered. Fund two was COVID. Okay, that was a very opportunistic period for us, and we're an opportunistic fund, so it's always a balance of explaining. I don't want to get too excited when there's misery, but we will make more money for you when there is misery. I couldn't have written the previous peer group's speech better. I smile because we're European focused, European diversified in terms of our origination. We do better during dislocation. So you kind of match two different funds, asset-based and private credit, but solutions. So you kind of got best of both worlds, US and Europe. I would say they've done a good job for you. But we will make more money in dislocation. That being said, which is going to be a better vintage? It it would be really easy for me to say, this is gonna be a great vintage, fill your boots. It's really hard to say that today because there is all of the unknowns right now. AI, my managing partner loves me to sort of run around and tell you all about what we're doing at AI. We're doing a lot, but there's still a lot more we don't know. So anyone that tells you they've spent, tens of millions of dollars and they have a great plan on AI, good for them. But I think that would be out of date in 3 months. So there is more unknowns than knowns today. I would say the stresses on the economy today are real stresses on the economy. It's loss of jobs. Before, when we've seen dislocation, it's been almost like a capital imbalance. So not what I would call fundamental deterioration in companies' growth. It's been financially engineered self-harm issues, mismatch of assets, short-term versus long-term liabilities. So, Fund 2 going through COVID, that was very attractive for us. Ukraine, that was even more attractive for us. So Fund 3 at the moment feels like, which you're in, feels like a good outcome. Fund 4 started off good, but then it looked like it was going to get very competitive, and now we're in this unknown territory. It feels to me that, I have a saying in the UK where, I get laughed at a lot. You don't get hit by the bus you're looking for. So everyone's looking at AI. Everyone's expecting the war to end early. Perhaps the market's pricing perfection too much. And I think there's probably more risk to the downside. Now, the good thing from our strategy, not maybe from a human level, is that if that was to come to fruition, then this could turn out to be a very good maturity and a vintage for European dislocation. We are the largest that do it, which gives us an edge. So Air is the largest in what they do that I just spoke to. We are the oldest and the largest at what we do, which gives us scale and firepower to take advantage of it. But as predicting what the overall vintage is going to look, I think it's still a bit early. We will be investing in this fund from 4 years forward, so that's still quite a long period. And I'm expecting some more dislocation.
And then unrelated to that, do you have deal flow from being owned by 40% by an insurance company? Is that helpful to you? Are they more passive?
Yeah, so where it's helpful to us is that we're seen as long-term, boring, and sometimes stupid capital, right? So, why is that helpful? Because what we do, particularly for this fund, is special sits. Nobody wants to go to Oaktree, Elliott, or SVP because they've got a different sort of flavour to how easy it is to work, right? So if you're an investor, you want to give your money to those type of individuals because they've got long track records. If you're a borrower, the last person you want to go to for complicated capital is Oaktree. Whereas we're a long-term, boring, patient insurance company, although we've all trained that way. So we definitely get a benefit from that sort of blue chip, long-term patient. Europe is much more conservative than the US. So pretty much everything we do is sole lender. Pretty much everything we do is sponsor backed. So you may try and say, well, why don't you do more non-sponsor deals? One, I don't like non-sponsor deals. I think that's marketing done for the US to make themselves look different. Because funny enough, one individual that controls a company, is that better than a board? Don't think so. The financial flexibility and deep pockets of private equity to put capital to work is much greater than an individual with an opinion, and probably a lack of diversity of opinion to pick up some key thoughts. So, we're not a huge fan of non-sponsored deals. So, but the European market doesn't really have a lot of that because leverage is seen as a bad thing. You will very rarely see family-owned businesses more than 2.5 times levered, and they'll generally be banks. What is interesting is we are starting to see in Europe the very first signs of the banks pulling away. So they've basically got very large syndicated books that are full. That's a good thing for us. It means that they're no longer going to be stepping into the market with their cheap capital, with an originate to distribute model, and they're unwilling to sit there and hold it on their balance sheet. So you put all those things together, and it's kind of brewing up to be quite an interesting investing period over the next 6 to 12 months, I think.
To expand on the LNG points, we call it almost a halo effect, especially because Europe is so many decades behind the US in terms of corporate finance coming out of the banks and into the private fund penetration. And by us not having private equity arm, not having a distressed or loan to own arm, but being all long-term primary performing capital with a very old and conservative insurance rate, it creates a little bit more trust, I think, in our ability to penetrate some of the jurisdictions and raise money. Or raise loans, excuse me.
Any additional questions?
I just had one question, and I definitely remember this deal And I think it's great that we're gonna do this. But I may have asked you this question, we did dollars last time, we're doing dollars now, why are we not doing euros?
You definitely don't want to do euros, right? Because you, being a dollar investor, you get the benefit of the cross currency swap. Plus, you don't have to hedge it. So actually, every euro guy's going, why didn't I do dollars? Well, it's because you're euro based. So being a US denominated fund, or an institution, why you don't want to take on unnecessary FX risk anyway. So, and second of all, actually you benefit because remember the chat from your economist guy, I don't know if he's still here. The whole world buys dollars and sells everything else, right? Which means that works in your favor because ultimately the cross currency swap means that you get basically a free ride on about 150 to 200 basis points. So definitely you want to be in dollars.
So the compartment is USD based and then we run a hedging program to make sure you don't take the FX risk, but that has it resulted for a fairly long time and a nice uplift for US investors coming into Europe on the back.
On the credit side, we make sure everything is fully hedged.
So if you're a yen investor, there's a great example because we're going through this pain with a certain yen investor. Not in this fund, in another fund. Their return, despite the fund producing a 9.8% return, theirs is 4 because they didn't hedge their yen exposure.
Wow. Okay.
So just
I knew it was an important question and I couldn't remember the answer, but I knew it was a logical one, so thank you.
Thank you for it.
Any additional questions on Pemberton? Okay, I will go ahead and make this motion based on the recommendation of Council Investment Committee, advising repeat SIC staff and fiduciary oversight from RBK. I move that the State Investment Council approve a commitment of up to $100 million to Pemberton Structured Credit Fund 4 LP. This top-up commitment is to be allocated to a no-fee, no-interest co-investment structure. This commitment is subject to and contingent upon the Mexico legal requirements, Mexico State Investment Council policies, negotiation of any terms and conditions, and completion of appropriate paperwork.
Second.
Okay, we have a motion and a second. Is there any debate on the motion? Hearing none, so we have a roll call vote, please.
Treasurer Lori M. Montoya,
Waker.
Catherine Allen,
Yes.
John Baden,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer,
yes.
Mary Rowan.
Yes.
Thank you very much.
7 in the affirmative, motion passes.
Thank you. And all be again.
Being here. Thank you for making it available.
Thank you.
Okay, that takes us to item 3G, which is the RBK capital market assumptions. The request that we go through this, with some measure of brevity, but honestly, it the important points, obviously. Yes. And I'm going to duck out, but please go ahead and proceed.
Well, thank you, Mr. Chair. We did have a good discussion of this at the investment committee meeting. And it is important, it is kicking off the macro season as you will this time of year, tend to talk capital markets, how that impacts asset allocation, return expectations. And we do want to go through that process with you periodically. Now, you have the new dynamic of onboarding a new CIO. You want to make sure that their views are incorporated in this process. So we're not recommending any changes today, but just wanting to give you an update in terms of directionality of how our expectations for asset classes are shifting and the implications to your various funds on that. One other item that is relevant versus some of the changes that came out of the recent legislative session, some updates of implications to the funds, appropriations that we have detailed in this presentation that will likely impact the liquidity requirements for some of the funds that we can discuss. And that is really just a preview in terms of the type of work and analysis that we'll undertake as part of the asset allocation process. This is an important process generally. The asset allocation, I think, as we've preached for years and years and years, this is arguably the single most important and impactful decision that the trustees and fiduciaries make in terms of determining the appropriate risk level, the commensurate return level, at least expected return level for those funds and right sizing those over time. Now, these allocations we've gone through, we look at them on an annual basis, we adjust as necessary, but the last wholesale review was done in 2023. So this year, we're on a 3-year cadence. This year would be the one where we take another closer look based on all the things that factor in. I think your favorable net cash flow profile that you've heard about extensively, Don will talk about, that provides you with some additional flexibility, being able to cover most of your outflow needs with both contributions, but also a maturing private market portfolio that's essentially self-funding. So there's all these dynamics that are factoring in, and we want to make sure that we maximize essentially the growth and the benefit to the state from this very fortunate period in time that we're all here experiencing. And so this is, again, as I said, an important part of this process, but we'll likely come back to you once Kristen has had a time to get settled, get a handle on the portfolio, and express and reflect her views in this process. So if I could, we just wanted to highlight on page 367, that is just a quick overview of some of those legislative changes. I think you've received a staff memo on that as well, but again, wanted to highlight how that might impact future liquidity needs for the funds. Early childhood and opioid are the two that may see some appropriations in the future. Again, just saying if we need to liquidate a certain percentage of those funds, somewhere between 7 and 25 between early childhood and opioid, do we have the right degree of liquidity in those funds to be able to not take a haircut? So that's important. Again, no action immediately, but wanted to highlight that. On 369, page 8 of this presentation, you'll see the summary matrix using the current taxonomy of high growth on the more aggressive side on the very left. Those tend to be funds that are return seeking, more to yield focused or preservation focused on the right hand side. As the number of funds has grown over the years, we've found certainly a need to similarities in terms of attribute objectives. And so that's why you see those funds bucketed in this way. So now when there is a new fund that is introduced, we're not starting from scratch. We're essentially with staff doing some due diligence on what are the dynamics of the funds, the expectations, the constraints. Is there a natural fit within your, again, current bucketing or taxonomy that you have here? If so, we'll look at that allocation as a starting point. Otherwise, there may be a need to introduce a new one. One of the enhancements that we've made this year, it seems relevant, is also designating whether there are legislative appropriation provisions for that fund, because again, that's going to be a very impactful characteristic for that fund that should be recognized. And at the very bottom, you'll see just some high level highlights in terms of expectations from return, the yield, so the income amount, and then as well as your max drawdown, your value at risk, if you will. Essentially, what does 2008 look like? And of course, on the left-hand side, you have lots of return generating ability, but also a lot of potential downside. As you slide to the right-hand side, you see that the return comes down, but your risk also increases. So just showcasing some of the have to be able to take on or accept some level of risk to generate return. It's, are you getting properly compensated? And that's really our role in terms of helping determine and assess when there is a good time to maybe go out further on the efficient frontier and seek additional risk, and when perhaps you're not getting properly compensated for that. This is actually year 370, page 370, we'll move on to that, where we are starting to see that efficient frontier flatten, that capital market line. We're going out and seeking lots and lots of additional risk is likely going to not be properly compensated. You've heard some of that in the earlier presentations about risk maybe being asymmetric, or perhaps a lot of the upside currently being priced in. It's not to say that things can't continue to run, but certainly our expectations are moderated somewhat based on the strong returns that we've experienced over a number of years now, but particularly in 2025. I'll just give you some of the highlights. You see it at the bottom, really the key building blocks, both equities as well as debt. So those are your two main building blocks, and then there's lots of various forms around that. Have come down some. Hopefully not surprising when you consider equities last year putting up somewhere between 20 and 30%, depending on what region you're looking at. Even very traditional boring fixed income provided over 7%. So these are relatively strong returns and have just boosted the overall valuation levels for most of these asset classes. Now, we're not forecasting what will happen this year or in the next 18 months. We don't really have any insight there, but valuations and some of the fundamentals do tend to be reasonably good predictors for longer run expectations. And there's lots of academic evidence that substantiates that. You'll see our expectations moving up and down incrementally, short of the market just completely falling apart like it did during GFC or at the beginning of the pandemic. Typically, you'll see incremental moves up. This year, most of the asset classes were decreased by about 25 to 75 basis points, more leaning towards that 25. A couple like international equity and emerging moving down 75 basis points. But again, you put up close to 40% when you look at it on a trailing 12-month basis here. So very, very strong return. And that, of course, had implications on forward returns. Since took some of that return that we expect in the future that was essentially pulled forward. Page 371, that's just the output there, and these tend to be our ingredients, if you will, that we use for our mean variance optimization, the asset allocation process. As I said, you can see that traditional assets have come down some, real assets and real estate modestly ticked up. Within real assets, that's largely a recalibration of the risk as we have more information, arguably better information, and trying to right size that risk level, which arguably maybe have been a bit high in historical years. So we're trying to bring that more in line with other asset classes. And then real estate has, of course, been beat up now for a number of years, but income has been very stable through that period, and appraisals, occupancy rates are starting to build. So there's a bit of upside, if you can call it that. Certainly better than in some of the near-term years. And then down below, as you continue to make progress both on the venture capital, but also the ETI, the in-state investments, we've taken a finer point to that and reflected some of the newer composition and types of investments that are being made there. So you'll see a bit of an increase in expectations from essentially zero returning asset for ETIs to something that actually is going to likely produce some positive return in the future. Again, SBIC stable and growing, and then the recovery loans are going to start to roll off, which has been a real drag on that asset category largely. On 371 or 372, the next page, this is essentially the attribution, what has changed at the fund levels, at the very aggregate level, and we break it down between beta change, which is essentially a change in our expectations for the capital markets on a year-over-year basis, and how much was methodology or structural changes. If you make some kind of a structure study with your asset class directors, or were there other methodology improvements, and how much did that impact the returns? And down below, you can see the scorecard. Essentially, as I said, most of the funds across the various categories decrease somewhere between 20 and 25 basis points. The more conservative ones, slightly less so. And most of all of that really came from lower expectations for the asset classes, as I mentioned. In some years, it's more methodology, and in some years, it's more beta. This year, it's almost all just lower expectations for the various asset classes. Now, keep in mind, these returns are just assuming market exposure. You're picking average manages. You're not having a lot of success in terms of implementation. You're not negotiating better fee terms. You're doing all of that. So this is conservative by design. We're not wanting to promise you a big return that has a lot of variability. This is just if you're in the market and capturing the data that's available, this is what you get, but we'd hope to do better than that. And then finally, on page 374, this is the efficient frontier with, for all of your various, asset buckets, as I've said, along with your current, policy targets. And you see that you're efficiently allocated, across the efficient frontiers in the portfolios. So there's no immediate need to make changes. All those portfolios continue to be efficient in terms of generating return for the amount of risk that they take. That said, I do expect to come back later this year with collaboration of your new CIO, Kristen, to see if some of the changes make sense, and again, if there's an opportunity to maybe get some additional return given the favorable cash flow dynamics that we expect to continue. So in the interest of time, I know I promised brevity, I'm not sure if that met the mark.
Great. Any questions on the capital markets assumptions?
Mr. Chair, I have just two comments.
Yep.
Matthias and Marcia, and two fellow council members, that page 365, this process flow chart is critically important. Even
Yes.
though this can cause great yawns, this is what we do. This is what we're all about. Someone on staff, someone on the SIC, all of us collectively, this is what we're doing here. I get asked that all the time. What do you actually do?
Yes.
So I just wanted to point that out.
We need to give Dawn a lot of credit
Yeah,
for that.
absolutely.
Yeah.
Yes.
Yeah, and also it ties to all of Dawn's analysis, which is excellent, but it's hard to visualize where it all fits in.
Yeah.
And then if you had to carry one sheet of paper around with you all the time, as council members, it would be page 369. Which is, I don't remember seeing this a few years ago, and I think you created this by request, and it's excellent. I mean, it's all you really need to, it's a blueprint for all 14 funds, how they're positioned. I believe in a future session, we're gonna talk about drawdowns and so forth, but this is it in a snapshot, so thank you for that.
Yeah, and if you have any suggestions as you're out there talking to other constituents, stakeholders, let us know. We're happy to refine this. Yeah, the last slide does show max drawdown, that maximum loss. But yes, we continue to try and improve it, and your staff always offers lots of great suggestions as well.
I do have one question on that specific point, actually, which is it possible when you run these Monte Carlo simulations to look at that max drawdown over like a longer period, for instance, a 3 or 5 year period?
We have it in the back of the report.
Okay.
Yeah. One, 3, 5, and 10.
Gotcha.
This is the periods that we have. Of course, as you get longer in time, right, the range of outcomes narrows.
Yeah.
But yes, we do have that in there. We're happy to.
Okay. We'll spend some time with that. And then on 378, just on the large cap equity, I noticed you're forecasting kind of a valuation decline. I mean, is that pretty typical that you sort of look at where valuations are and you sort of assume some mean reversion, or?
Yeah.
You're effectively.
Yeah, so this is, also looking at Schiller Capes, in terms of where's the historical norm. But but we also recognize that there's some momentum built in, that it's gonna take some time to get there. So, yes.
Gotcha. Okay, understood. Any other additional questions? Okay, thank you very much.
Please.
We will now hear from Don Iglesias on inflow, fund growth, and beneficiary distribution model.
Absolutely. I'm actually gonna start you out on the same flow chart that you referenced, Mary, that's on page 457. And just wanted to give this quick overview on how the capital market assumptions you just heard are flowing into what I'm giving to you now, which is ultimately where do we think fund growth is gonna go, how big do we think our assets are gonna grow, and ultimately, at the end of the day, what we do here is distribute to our beneficiaries. That's the primary reason we exist. So what do we think those distributions are gonna be, and what are we giving back to the state over the next 20 years, but really focusing on the next 10 years. And this process flow chart illustrates how that all flows in. So kind of here in the center, in the middle, you have our total asset growth, and the key contributing factors to determining what that is going to be our long-term expected compound return, which we just got from RBK's report. The other sheet that Mary referenced that has the matrix of each of our funds has their estimated compound return. So as for these assumptions, we just assume that each year we earn the 6.8% average return for land grant, or follow through for each of those funds. What are those expected returns if we were to get those returns, in addition to the inflow estimates that I'm about to provide to you. So we grow the funds through inflows, if we grow the funds through returns, while also considering what our required distributions to our beneficiaries are based on their distribution policies that are set in statute. Each of those are going to come together and define what our asset growth is. So if we're looking at the next page on 458, these are the total inflows we've received over the last 5 years, along with this year's estimate. We're expecting, according to this current analysis, around $5 billion this calendar year, with significant uncertainty and considerable upside risk depending on how things play out with the Iran conflict. And I'll go over some different scenarios that we're looking at and try to help you understand what is currently baked into this forecast, as well as what's not yet there and what remains to be seen and how that might play out in these estimates. So next page, 459, this is an illustration of each of our major funds that receive oil and gas revenues, along with any other inflows that we get, say, from legislative appropriations, which is typically, we forecast for the future, but it also includes things like tobacco settlement revenues, opioid settlement revenues, etc. That's the small, tiny blue bars at the top. And this gray line in the middle is the estimate from May 2025. So the last time I presented this to you was in May. What was that estimate at the time? And these long-term estimates for the next several years are roughly $1 billion higher than what those previous expectations were last year. That's going to be largely a function of the production assumption. It's on the next slide. I'll get there in just a second. That's really increased that long-term forecast outlook. We have not changed the long-term forecast price assumption that we've used, which is $60 a barrel. And I'll explain why for that as well. But that difference that you're seeing now is not a change in our long-term price assumption. It's a change in our long-term production assumption. Now, the near term is where we actually are forecasting prices by using price forecasters like Oxford Economics, Rystad Energy. We look at EIA. We look at what NYMEX is doing, and we say, okay, where do we think near-term prices are going to go? Let's adjust our price expectation for the near term. And then for the longer term, we're saying as long as prices are at least 60, we would expect to get this amount of revenue without trying to pinpoint and change every time what that price expectation is. So you can see we are up considerably in 2026 from where we thought we would be last year when we were expecting this year's amount. That's largely because we have increased the oil price assumption up to $70 right now for 2026 across the full year, up from around 61 was what we were expecting last year. Now that 70 could be low, and I'll go into why and what we might expect for the future. But it's also partially offset by around a $2.50 expectation for natural gas. Henry Hub is running at about $2.90 right now. We are actually trading at a considerable discount to Henry Hub for Permian Basin pipeline constraints that are occurring in both our southeast region of New Mexico as well as in the Midland region and the Permian region, for the southern Delaware region that's in the Texas side. Waha's taken a bigger hit than we have in terms of New Mexico's oil prices, but we are still seeing those constraints, and we're trading right now at about $1 to $1.50 discount to Henry Hub. So that's also baked into this price expectation. And we also haven't seen the same impacts of this war so far on US natural gas prices. So we're still at about $2.90, $3 for Henry Hub prices. Whereas the bigger hit is being seen for European gas, which has spiked up pretty significantly. And that's largely because our pricing factors for the US are largely domestic. We have mostly domestic pipelines, mostly domestic supply. We're driven mostly by domestic forces for natural gas in the United States. So we haven't seen that impact on Henry Hub. Next page on 460, this is where the production outlook has significantly changed. And I'll point your attention to the long-term natural gas expectation. So the prior estimate had assumed that both natural gas and oil would peak around the early 2030s and continue to decline thereafter. And Rystad's most recent update in looking at the long-term capacity needs or long-term supply needs for natural gas as part of a transition fuel for the energy transition and long-term supply for power plants, for data centers, et cetera. The call on natural gas is expected to be much larger than what our major natural gas basins, like the Appalachian basins, Marcellus, can meet. And they think that the prices, assuming they're at least roughly $4 per MCF, which is the current price expectation, that would incentivize additional drilling in the Permian Basin in the future, specifically for natural gas, as opposed to what we currently have, where we drill primarily for oil and we get a ton of associated natural gas. And their new expectation is that in the future, around rough late 2030s, 2040s, you'll have such a demand for natural gas, you'll need to target the Permian Basin for that demand. And so would actually drill deeper into the substack rock. Currently, we drill into the rock what they call Wolfcamp A through D, and we drill primarily in A and B, where it's very oil rich. But the expectation is that the lower sections of the rock, which is Wolfcamp C and D, are much more gaseous, and that we will start drilling for that lower portion of the rock, primarily for the gas supply, and what we'll end up getting is associated oil. And that's why the oil expectation comes up. While still expected to continue its declining trend, it's up much more significantly than the previous expected decline, while natural gas is expected to continue to rise. Because of that gas to oil ratio, we've been pulling up significant amounts of natural gas, but also still pulling out additional amounts of oil. So it's these two supply factors in combination that are pulling up that base case expectation and adding considerable amounts of future expected inflows into this forecast. The next item on 461 is now looking at prices. And so the dark blue line, and I apologize if there are two identically matched lines here, one for Oxford and one for NYMEX. That was not intentional. I had two different colors on one side of the chart. I pulled it over, they ended up matching. I apologize for that. But the dark blue line, the non-dotted line, is our current modeling expectation, where we're looking at about $70 oil, and then that coming back down to just below 60 next year. The function of that is, at the time of publishing all of this data, which was the very beginning of March, on March 6th, we had the latest forecast from Oxford Economics was published on February 28th, before the Iran war began. The publication from Rystad Energy was on March 5th. At the time, this was expected to potentially maybe last only a week or two before a ceasefire was reached, and then hopefully things started to normalize. Now, since then, a lot has happened, and the new expectations that have come out of Oxford are looking at roughly $85 average for the year, so high in this quarter, potentially around that 90 to 100, maybe a little higher, but then coming back down, so that you have about an $85 average for the year. Rystad's newest forecast that they're coming out with is looking at something similar, around an $87 average for the year, with high prices this quarter and potentially next quarter before starting to normalize by the end of the year. The duration of the conflict really matters in what that price expectation is going to be, and ultimately how it affects our inflows and how we think about it on a calendar year to calendar year basis. So for example, land grant permanent fund, the dollars that we get in the door today, what the distribution we get from the land office for March specifically, is not March production. It is actually December production. We're on a 3-month lag. So if we think of it that way, the calendar year that we will get production for land grant is based on production from October of last year to September of this year. And half that year's already done, and most of that price was around $55 to $60. So that average for that land grant calendar year would need to have sustained prices of about $110 for the remainder of the year in order to get to a $100 average. You would need to have, if you had sustained prices of about 90 For the rest of the year, you'd get to about an $84 average. So when we're looking at these estimates, I'm giving them to you on a calendar year average basis, noting that there can be some fluctuation in between months and quarters on what ultimately brings you to the expected price for that calendar year. And early childhood and severance tax make it even more complicated because the distributions we get those big distributions usually in September and December, but they're based on fiscal year production. That fiscal year is almost already done. We're in the last quarter of the fiscal year. So whatever happens in the next 3 months could potentially push up those 5-year averages and those amounts above what we were previously expecting. So we might get a bigger distribution this year, but prolonged prices is actually more likely to affect next year's distribution because it'll be based on that fiscal year 27 calendar year. So a lot of moving parts in that piece. And the next slide is really just talking about some of the things that are arriving with that price uncertainty. At the end of the day, what really matters is how long this conflict lasts, the duration of the strait's closure, and the amount of energy infrastructure damage that is maintained during that, which will affect the subsequent recovery and the length of time that it will take. Now, we actually entered the year at with a narrative of oversupply. We about $58 a barrel WTI at the very beginning of the year. There was a lot of spare capacity available from OPEC Plus to be able to announce releases of or increases in production quota. You notice at the start of this conflict, there was an announcement that OPEC Plus was going to increase production capacity in their quotas, which meant nothing to the market because all of that increased capacity is held up in the Strait of Hormuz. It doesn't have an exit route. There also aren't very many alternative exit routes because of pipeline capacity constraint in order to move through alternative routes that aren't the Strait of Hormuz. Actually, Iraq and Kuwait are almost entirely export unavailable. They have virtually no additional export routes. And there's also infrastructure constraints there. So even though some alternative routes exist, there aren't a lot of options that are available. This is also one of the very first times, even from the conflict in the 1970s and 80s, that you have simultaneous multi-country shut-ins from all major Gulf producers: Saudi Arabia, Iraq, Kuwait, UAE, and Qatar. And that hasn't actually occurred yet. And for every single week that infrastructure that they have shut-ins in their production, it weakens the recovery thereafter. These are very mature basins. Every day these wells are shut in, they're losing pressure. That is really complicating the ability to turn things back on if it's available. And then once you start adding in a tax on energy infrastructure, you have significant constraints in terms of repair of that infrastructure. Rystad is already estimating that damage to the industry since the start of the war totals at about $25 billion in repairs across the Gulf, and that's engineering, construction, equipment, materials. The expectation is that even if you had an immediate ceasefire, your best case scenario is a 6 to 8 week recovery. And that's assuming that once they go in and assess everything, we're ready to up and run. That's unlikely to actually be the case. So you could be talking about very long-term issues with that recovery. And because that excess capacity has been sort of shut in and constrained, and some alternatives for other OPEC countries and their ability to increase their excess capacity, you may get headlines of increased quota without an actual realization of increased supply. And the structural impairments that are there could actually be incredibly damaging. So the extent to which the price, you get normalization or recovery, again, depends on how long it lasts. The two scenarios I'm looking at here from Rystad, they publish a daily update. I've been tracking this each day once they come out, but they're looking at a sort of 2-month war. This is their base case where they're saying the Strait of Hormuz is somehow reopened around mid-April to May to more than just their friendly allies. And under that assumption, you would still get price spikes over 100 potentially within the next month or two, but then potentially normalizing to around $70 by the end of the year. If it lasts 4 months, you could get spikes above 130. When Greg earlier mentioned that you could have price spikes around 150, that's not unreasonable as a thing that could happen. And then in this 4-month scenario, they have normalization to just over 80 by the end of the year. And that's under a 4-month scenario. What they're identifying is sort of their worst possible case is that this lasts more than 4 months and you get very long-term, very structural damage, not just to the infrastructure that's there, but to global supply chains for a number of things. The Strait of Hormuz is actually where about 20 to 30% of the world's fertilizer runs through. The Middle East producers supply about 40 to 50% of traded urea, which this is a nitrogen fertilizer that underpins roughly half of the global food supply. So very, very severe implications beyond just that of oil, which already will have long-term knock-on effects. We're already seeing in South Korea that there are petrochemical plants that are having to shut in because they don't have enough feedstock coming through. So you'll start to see additional knock-on effects that will go further down into the supply chain. We're also already seeing that the Strait of Hormuz is where a lot of aluminum generally passes through. It's about 9% of the world's supply of global aluminum that's used for fuel-efficient transportation and energy infrastructure, solar panels, wind turbines, transmission lines, all of that's made from aluminum. Helium, which is a byproduct of LNG, that is used for a lot of things that you wouldn't expect, not just party balloons, but semiconductor manufacturing. MRIs need to use helium. Welding is really heavily reliant on helium. So you can start to see these things show up in a lot of different places you didn't necessarily expect. Now, there are some additional issues in thinking about, okay, what will this translate for New Mexico producers? What prices will we potentially be getting? Well, right now for March, as of the current month of March, we're looking at about $87 on average is what we've been receiving based on our closest proxy. Again, we won't actually know for 3 more months until the data is reported, but our closest proxy suggests our New Mexico producers are receiving around $87 on average. Now, there are a lot of E&P shale producers, especially public producers, that have hedged prices at the beginning of the year. And so they're looking at price hedging around $60 to $70 a barrel and may not be able to actually capitalize on a lot of the upside price. And then if we're thinking, well, does this upside price, will it translate into additional production? Maybe, depends on how long it lasts. But so there's a few constraints for reasons why it might not. One, a lot of public producers already issued their plans at the beginning of 2025. They've already issued their guidance for production, and they would need to both see long-term price changes as well as a potential for that price to stay elevated to warrant change to their yearly guidance, which may not be possible and would need to affect next year's guidance. Then you have limited duct capacity. So last year, and in previous, even in 2022, there was the additional option to take drilled but uncompleted wells and go ahead and finish completing those and be able to capitalize on the new higher prices for ducts that were already ready. But there's actually very limited duct capacity now. A lot of that excess duct capacity was utilized last year. So there isn't much that can be turned on short term. So they'll need to be able to look toward sustained prices high enough for long enough to warrant more additional drilling of new wells, and that may or may not happen. So just a few things that we're looking at. Look for the current year, for 2026, if we were to have, say for right now, we have that $70 average. If we were to average $80 for the current year, we could be looking at another $1.5 billion in inflows this year. If we were to average $100, we'd be looking at about $2 billion for this year. Now, again, the knock-on effects go for next year. So if we were to sustain $80 prices all through next year as well, we could be looking at another 2.5 billion next year. And if we were to sustain $100 all into next year, that could be upwards of 4.5 billion based on how those rules play in. So at this point, how much we'll actually get in 2026 remains to be seen, and it really depends on a lot of these dynamics and how they play out. We will be tracking them closely and happy to provide any additional updates to the council that you all need as this plays out. But looking through next page on what this means for our long-term growth, taking the current assumptions that we have, we play those through along with RBK's new capital market assumptions. This is the change from the last time I presented to you on what the expected growth is for the fund. Last time we presented, we thought we could hit 100 billion by 2031. Now it's looking like it could be 2030 and quite possibly much sooner than that if we were to get big inflows over the next year or two based on the current war effects. So lots of potential upside. This has been revised up from the last time. And what that means is actually on the next page translating into great benefits for New Mexicans. So over the next 10 years, we expect to distribute back to various entities, including the general fund, K-12, higher education, early childhood, about $42 billion over the next 10 years. That's roughly 2.5 to 3 billion in this next upcoming year and ramping up as our funds continue to grow in size. So very much supporting a robust revenue streams for a lot of critical foundational services that are provided by the state. I do also have some scenario analyses. I won't go into a lot of detail for these. I know I'm standing between us and lunch. I'll just point you to page 469, and this is essentially if you run through Rystad's various energy transition scenarios, they have a handful that make different assumptions on long-term EV adoption, plastic recycling, use of fuel in aviation jet fuel, maritime sectors, trucking sector, et cetera. And they go through several different scenarios, one at which they consider a high scenario, one at which they consider a low scenario, and then they have an even lower than that, which would be a 1.6 degree scenario. So things that would have to happen in order to limit global warming to 1.6 degrees. And so under those different range of outcomes, if we were to change our inflow assumptions and nothing else based on those expectations, here's how our growth outlook would change. So by 2035, our current base case is that we'd end up around $142 billion. That's not that much different than their house scenario by the time everything plays out. On the high side, it could be as much as 167. On the low side, we would still anticipate reaching 100 billion. Happy to answer any questions that the council has.
I do.
Thank you very much. Question?
We're gonna be speed round. So $1 shift per gallon barrel is about, or $10 is 25 cents, correct? Just ChatGPT it.
I'm sorry, I don't understand the question.
So you kept saying the gallon went from 60 to 75 or 70 to 85. And in perspective, I remember this from my college days, $1 was different from today. Today I looked it up and it's the $10 change is 25 cents. So you're telling us from the SIC perspective of how this looks, from the person who's putting gas that's on the shift, there's that whole other side of the impact of what gasoline looks like, which then means that there might be potential for them to try to utilize more money during legislative sessions because we're making more money on this end, but somebody's always gonna get screwed and someone's always gonna have a benefit, right? And so looking at the benefits or looking at the stuff that's not as beneficial, depending on what side of it you're on, there's an inflationary increase in this that keeps the interest rates high, which can hurt equity markets on one end. You have the borrowing costs rising. You have people struggling or suffering if they are lower income. And then there's a downward pressure on their stock prices as well. So you're benefiting on one end, but then you have to, from the net return, also subtract where you might be hurting yourself on the other end because of that diversification tool, which is why you then put us the scenario of how much more we would get. Is that all true so far?
Yes.
Okay, and then, so that was a good point for me to get from what you said. And then the 2.5 to 3 billion, if you remember when we first started the conversation and I went back to what SIC had put in, we were giving about 1.7 this year, 1.4?
2.6.
We gave 2.6?
Yeah, the 1.7 was land grant.
Was just land grant. So in total, it would be 2.5 to 3 billion. So you're saying consistently, even to that point, we didn't increase it in this bucket of the 10 years that you put in the square of the 42 billion.
Madam, Mr. Chair, Madam Treasurer, so it did increase a little bit, so our estimate for 10-year contributions back or distributions back to the state this past fall was 38 billion, now it's 42 billion. So that's the increase.
Thank you, that's all.
Okay.
Great, thank you so much.
Additional question, Member Brown?
Gonna comment, I'm actually an optimist, but I'm not. I feel like I'm the doomsday person here, but just as the treasurer said, there's a really good upside on our inflows, but I think the demands of the state for whether it's gonna be health or social services or things are also gonna go up. And just the story of the fertilizer, farmers already are in distress, and then the fertilizer, having access to better supply chains. And as I mentioned last week, I was with all risk managers talking specifically about supply chain things. It's plastics, there's so many things that we don't realize, my Coca-Cola will go up in expense that are going to impact at the same time people with upper income salaries are getting laid off. And I feel like we have to keep thinking about scenarios that could be really bad.
The knock-on effects could be potentially catastrophic if the longer it lasts.
And I don't wanna be political, but I think there are other forces that are behind the decisions that Trump is making. They're being influenced by both Russia and Israel, and that is gonna have an impact of how long this goes. I mean, Trump may be trying to pull out or want to save face, but that may not be possible. The war will continue. I'm good.
Chairman,
Summer?
Mr. Iglesias has an excellent report. Thank you for all your work. I can't imagine the amount of time that you have in that. But two questions. Do you see any effect by Venezuela in there with their production if it comes on? The second question is, assuming the sanctions on Russia stay off, does Russia play a role in the world market in a way that would have an impact on us?
So that is both excellent questions. So right now, a lot of our base case assumptions do utilize Rystad Energy. They've produced some really interesting analysis on infrastructure constraints that are existing in Venezuela. So there isn't right now looking like there's a ton of upside capacity there. Even if there was new investment, it could take many years for that to start to flow through. So in terms of immediate relief, unlikely to provide that. Now, in terms of Russian supply, it could potentially help kind of offset some of the upward pressure on prices now, potentially releasing some additional barrels, but not nearly enough to make up for the losses that we're having by these Middle Eastern producers. So at best, it could alleviate some additional upside pressure, but not certainly enough to offset.
Thank you.
Any additional questions? Any questions on the phone? Okay, well, thank you for that excellent analysis. And that takes us to our CFO report, Mr. Ship.
Mr. Chairman, I'm on page 475 and I just wanted to make 3 points if I could, and that's all I need to do today. I think I mentioned last meeting that we are in the process of submitting a budget adjustment request. I had anticipated up to $20 million. I worked on a draft of that yesterday. I think I'm going to elect to go as high as $24 million, but that will be submitted over the next several days and will be reflected in our updated budget schedule for next month. And then for next month, we're also going to have a preliminary budget for fiscal year 27, which aligns the approved appropriations request that we just got. So be on the lookout for that. And then lastly, I just wanted to mention we're in the process of putting out an RFP for independent or external audit services. It'll probably be May before we have a final selection on that, but that's something that we have in the hopper right now. And other than that, everybody should have the latest budget schedule through the end of February, as well as the investment holdings report for the same time period. If there's any questions, I'm happy to answer them.
Yep, Madam Treasurer.
Thank you. Quick question on page 477. You're saying 24 million, is that for which category?
The middle category, largely related to management fees.
As billing, only because, and I love that you put those percentages there, don't you love it? It's
I do.
easy cheat sheet. It's looking at like 8% per month, on the standard, so 16%, so you're like right there for payroll.
Yeah, actually, if you look at the pending quarter that we have, we don't have any budget for the pending quarter, so the budget adjustment request is primarily there to address that shortfall.
Okay, and then the last question out of curiosity, who is Interstate Stream Commission? Improvements to the Rio Grande or irrigation works construction?
I want to say that's the Department of Engineer. Yes. And it's a client.
Okay, yeah, we have a lot of clients, so I just say for everyone outside of everything we just talked about, taking a look at how many other entities we work for and do work on behalf of, who could also potentially be impacted by all these shifts, are on page 498. Thank you, Ship.
Thank you.
Thank you. Any additional questions on the CFO report? If none, thank you for your report.
Some of your bar.
And let's go to closing matters, any old or new business or informational items.
One, April 20th, we're having our UNM NMSU collaboration on this concentration in government accounting, budget and investing. John Clark, Don Glessier, and Mr. Dunn are going to be part of our panels, so our para and URB directors and CIOs. So it's an exciting way for us to connect our students to have a bridge into working for the state of New Mexico in finances.
What time is it?
I'll send out the invite to all of you once we get it all coordinated, but it'll be 9 to 12 at the new building that finance is in our road. But I will send it out.
Yes,
This is
actually,
exciting.
I'll send out on April 16th for the International Women's Forum. I've got two experts on the impact on society of AI on everything from jobs to the economy. Things like that.
I saw that.
Okay, awesome. Any public comment today?
Mr. Chairman, no, thanks.
Okay. Our next meeting will be Tuesday, April 28th, same time, same place. Is there a motion to adjourn?
So
For the second, we are adjourned.
thank you.
Yeah.
So, two more questions.
Yeah.
I don't know, I don't think we've got any programs.
Yeah.
Just a show.
Well, so it's gonna stand up.